Yeah, okay, there we go. Hearing will come to order. Welcome all to an important hearing. Thank you. I will start with a brief opening statement and turn it over to my friend, Mr. Van Holland, and then we'll listen to our witnesses. The purpose of today's hearing, in conjunction with the conversation we had with Mr. Van Holland, is to highlight the need for pro-growth tax reform. Our economy is currently suffering from the reluctance of job creators to invest, expand, and hire workers in the United States. For several years, Washington has followed a now discredited playbook. If businesses won't invest, then the government should expand its reach. But letting the government pick winners and losers in the market only adds to the debt, wastes taxpayer dollars, promotes crony capitalism, and ultimately fails at sustainable job creation. For evidence, look no further than Solyndra, a solar panel company that received $500 million in stimulus-funded loan guarantees. Last month, Solyndra filed for bankruptcy and laid off its employees. Another idea we've been trying for the last 3 years under first President Bush and then President Obama is short-term tax rebates, on the theory that these temporary windfalls will encourage people to go out and spend more money. Look, I don't object to letting people keep more of their own money. I clearly think that's a great idea. But one-time rebates and short-term tax policies do not give businesses the confidence that they need to make the kinds of long-term investments to create jobs. That is why, of all the proposals the President has put forward in his latest speech, the most encouraging was his support for making the corporate tax code fairer, simpler, and more competitive. This is a sign of encouragement. We should extend these reforms to the entire U.S. tax code. A world-class tax system should be fair, simple, and competitive, and right now, the U.S. tax code fails miserably on all three counts. The World Economic Forum recently downgraded the United States from 4th to 5th in its annual competitiveness rankings. The reason? Under the section titled Most Problematic Factors for Doing Business, our unfair, complex, and uncompetitive tax code was right there at the very top. We need to close loopholes that distort economic activity. And those loopholes also reward politically well-connected at the expense of the hard-working small business men and women of America. We need to simplify the tax code by reducing the number of brackets so that people spend less time and money figuring out how to comply with the tax code. And we need to lower rates to encourage economic activity, to allow our businesses to compete on a level playing field against those in countries where the corporate rates are much lower. Unfortunately, that list includes every developed country except for Japan. There is a growing bipartisan consensus for this kind of common sense tax reform. The President's Bipartisan Fiscal Commission made very clear that a revamped tax code with a broader base and lower rates was critical to economic growth. That's one reason why House Republicans included in our budget these reforms in the path to prosperity. Lower rates and a broader base to help get our economy growing again. Unlike the high-cost government spending proposals now circulating in Washington, fundamental tax reform could be done with no budgetary cost, and it would provide many immediate and long-lasting economic benefits. At today's hearing on the need for such reform, we will hear from three terrific witnesses. In addition to experts Scott Hodge of the Tax Foundation and Diane Rogers of the Concord Coalition, we have a witness today from the world of business, Michael Wall of Case New Holland, which is headquartered in Racine, Wisconsin. Mr. Wall can speak firsthand about the effects of tax policy on business decisions and job creation in the United States. I'm looking forward to hearing from all of you on a topic that is critical to laying the foundation for sustained economic growth and job creation. And with that, I yield to the ranking member, Mr. Van Holland.
Thank you, Mr. Chairman, and thank you for bringing us together in this hearing. I want to thank all of our witnesses. You know, there are a lot of committees in Congress that just look at one subject matter area or several subject matter areas. You've got the Transportation Committee, you've got the Education Committee. The advantage of the Budget Committee is it allows us an overview of the budget. And we had a number of hearings in this committee, very important hearings that looked at some of the impact on the budget of the rising costs of some of the programs, healthcare programs in the country, Medicare, Medicaid, others, due to changing demographics and other factors, including the high cost of healthcare. And we've looked at a number of other parts of the budget. I think also as we look at the deficit situation that we're confronting, especially as it grows in the out years, we have to look at the role of revenue and figure out what's the best way to raise and generate that kind of revenue as we approach a budget that deals with both the spending side as well as the revenue side of the picture. And I'm glad the chairman mentioned the Simpson-Bowles Commission, because I think they did put a lot of ideas on the table for how we can simplify our tax code. I would point out that at the same time, they used a considerable part of the savings they generated through their tax reform to reduce the deficit, which is obviously also a very important component of our overall economic strategy. Now, we had the first hearing of the so-called joint committee yesterday, and Dr. Elmendorf, the head of CBO, testified, and he made two really important points. One was he reinforced the point of earlier hearings in this committee about the rising out-year costs that we face. He also made the point that if this Congress were to adjourn right now for 10 years and just let current law kick in, you would actually generate, you would reduce the deficit by over $4.5 trillion simply by allowing the old Clinton tax rates to go into effect and a couple other changes. And, you know, people talk about going big, let's do something big. I just want to emphasize the point: if Congress packed its bags and went into hibernation for 10 years, you would exceed the target of those bipartisan commissions. Now, I'm not advocating that we do that, and I don't think anybody is, and Simpson-Bowles and Rivlin Domenici didn't. But I am advocating the fact that we need more revenue if we're going to avoid very deep cuts to things like Medicare. I mean, we've seen proposals that make dramatic, impacts on Medicare beneficiaries, and I think that those are, frankly, asking Medicare beneficiaries to pay too big of a burden for things that they've already invested in. So the trick is to devise a tax system through tax reform that both encourages growth but also deals with the revenue piece and is done in a fair way and a balanced way. There's no doubt that the tax system is chock full of special interest provisions, many on the corporate side. A lot of us don't think, for example, that some of the big oil companies should be getting big taxpayer subsidies at a time they're doing just fine, and why do they need that extra handout from the taxpayer? You have a lot of other provisions in the tax code that are absolutely unnecessary, and especially in the corporate tax side, there's a very strong argument to be made, obviously, in reducing the overall rate and somehow doing it in a way that expands the base. And I think there is room for common ground. On the individual side of the tax code, there's also room to look at those areas. Simpson-Bowles did. It gets even a little trickier on the individual side, but some of the same arguments can certainly be made. So I hope this is actually an opportunity to try and find some common ground as we go forward, recognizing, again, that Simpson-Bowles, Rivlin Domenici, Gang of Six, all these other bipartisan groups found a way to both reform the tax code in a way that made it, I think, more efficient in many ways, but also recognize the role that the revenues play as part of a balanced approach to reducing our deficit. And after all, that's what this committee has spent a lot of time looking at, is the out-year deficit situation. In closing, I would just point out that yesterday Dr. Elmendorf pointed out that there is absolutely no contradiction between trying to take measures in the short term to try and boost a very fragile economy and try and reduce the deficit over a longer period of time. And he specifically pointed out that a CBO study had found that if you look at different tax policy provisions, that providing relief at this point in time on the payroll tax holiday, on the employee side especially, would provide obviously a little bit more money in the pockets of consumers. And one of the main reasons businesses are not hiring is they don't have people out there purchasing their goods and services. So to the extent that people now have a little bit extra cash in their pocket, that would help boost the economy, along with other measures like the infrastructure investment. And again, that's not my testimony alone. That was also a point made by Dr. Elmendorf. So, Mr. Chairman, I'm actually hoping that this discussion can steer us in the direction ultimately of some common ground on these issues.
Great. Thank you, Mr. Van Hollen. We'll start with Mr. Wall, then Mr. Hodge, then Ms. Rogers. Mr. Wall.
Good morning, Chairman Ryan, Ranking Member Van Holland, and distinguished members of the committee. My name is Michael Wall. I'm Vice President of Corporate Tax for Case New Holland. I'd like to thank you for this opportunity today to testify on behalf of CNH. I applaud your leadership in holding this hearing on the need for pro-growth tax reform that will increase the nation's international competitiveness and be a driving force for job creation in America. CNH manufactures the tools used to shape the world, from machinery for building roads and schools for equipment for growing and harvesting food. CNH is perhaps the most geographically diversified manufacturer and distributor of agricultural and construction equipment in the world. We are present in approximately 170 countries with significant operations in the United States. In 2010, CNH's manufacturing in the United States accounted for over $7 billion in annual revenues, and CNH exported 34% of our U.S. production to global markets. CNH employs 10,800 people in the United States, and we are a majority-owned subsidiary of Fiat Industrial. Given CNH's unique perspective of having manufacturing, distribution, and research facilities all across the world, we believe that substantially lowering the U.S. corporate tax rate while preserving essential business growth incentives will significantly improve American business competitiveness and incentivize foreign investment in the United States. Unfortunately, there is effectively a 14% incremental tax burden between the combined 39.2% U.S. federal and state tax rate versus the 25% average tax rate for the OECD countries. In fact, virtually every industrialized country except the United States has lowered its corporate tax rate over the last 20 years. These countries chose to lower their corporate tax rate to attract and retain capital, improve the competitiveness of its economies, and provide pro-growth environment for job creation. CNH's summary view is that the U.S. corporate tax reform should include the following key aspects. First, significantly lower the U.S. corporate tax rate. Second, consider appropriate modifications to certain corporate tax expenditures in a fiscally responsible manner. Third, adopt a territorial tax system for the United States. In pursuing fundamental corporate tax reform, CNH believes it is imperative that corporate tax reform does not discriminate against U.S. subsidiaries of foreign domiciled companies. Recognizing that foreign investment is an engine for job growth and economic recovery, President Obama recently issued a statement in June highlighting the importance of foreign investment in the United States and reaffirmed the United States' longstanding commitment to open investment policies. CNH believes that the U.S. corporate tax rate should be reduced to 25% or lower to grow the U.S. economy and achieve a competitive corporate tax rate with our international trading partners. CNH greatly commends this committee for including a 25% corporate tax rate in its fiscal year 2012 budget legislation. I note that a 20% federal corporate tax rate combined with the average state tax rate would result in a U.S. corporate tax rate equal to the 25% average corporate tax rate in the OECD. CNH recognizes that fundamental corporate tax reform providing for a reduced corporate tax rate may be coupled with modification of certain corporate tax expenditures in a fiscally responsible manner. As Congress considers specific corporate tax reforms, CNH believes that the retention of accelerated tax depreciation and the tax credit for increasing research activities are vitally important to the sustainable U.S. economic growth and should be retained in any final corporate tax reform legislation. The United States is one of only 8 remaining OECD countries and the only G7 country that maintains a worldwide tax system that taxes U.S. companies on income earned in foreign countries upon the repatriation of those earnings to the United States. The other 7 OECD countries with a worldwide tax system have an average corporate tax rate of 21%, which is substantially lower than the U.S. corporate tax rate. CNH's view is that the United States should adopt a territorial tax system with an exemption for dividends paid from active foreign source income to achieve a competitive tax system in line with our trading partners. In conclusion, CNH believes that significantly reducing the U.S. corporate tax rate in conjunction with the adoption of a territorial tax system will make the United States more competitive with other countries, significantly increase investment in the United States, and lead to much-needed job growth for the American people. On behalf of CNH, I again thank you for providing me this opportunity to share CNH's view on fundamental corporate tax reform. CNH looks forward to working with this committee and the Congress in considering these vitally important issues. I'm pleased to answer any questions the committee may have. Thank you very much.
Thank you, Mr. Wellman. Mr. Hodge.
Thank you, Mr. Chairman, Mr. Van Hollen. I appreciate the opportunity to talk to you today about how fundamental tax reform can improve America's long-term economic growth and our global competitiveness. Since 1937, the Tax Foundation has stood for the immutable principles of sound tax policy. That taxes should be neutral to economic decision-making, they should be simple, transparent, stable, and they should promote economic growth. In other words, the ideal tax system should do only one thing, and that's raise a sufficient amount of revenues to fund government activities with the least amount of harm to the economy. And by all accounts, the U.S. tax system is far from that ideal. In fact, Mr. Chairman, the economic research suggests that the U.S. corporate and individual tax systems are undermining the nation's long-term economic growth. OECD economists have studied the impact of taxes on economic growth for the largest capitalist nations, and they've determined that high corporate income taxes and high personal income taxes are the most harmful taxes for long-term economic growth, followed by consumption taxes and property taxes. And this should be a red flag to all of us, because when it comes to corporate taxes, the U.S. has a Neiman Marcus tax system while the rest of the world has moved toward a Walmart model of corporate taxation. Not only do we have the second highest overall corporate tax rate among the leading industrialized countries at over 39%, but we are one of the few remaining countries, as Mr. Wall mentioned, that has a worldwide tax system. And the economic research tells us that cutting the corporate tax rate will not only help the country on a long-term growth path, but it will lead to higher wages and higher living standards. And as one of the reasons the Japanese moved to a territorial tax system is because they found out that a high corporate tax rate combined with a worldwide tax system creates a lockout effect that discourages the repatriation of foreign earnings. And so moving to a territorial system will break down the Berlin Wall that is keeping more than $1 trillion in foreign profits abroad. Now, with all deference to Warren Buffett, OECD research has also found that the U.S. has the most progressive income tax burden among all the leading industrialized nations. The top 10% of taxpayers in the United States pays a greater share of the income tax burden than their counterparts in any other industrialized country. And our low-income Americans have the lowest income tax burden of any industrialized country. And I think it's also pretty well known that about half of all American households now pay no income taxes because of the generosity of credits and deductions in the code. And the research shows that the more a country tries to make an income tax system progressive, the more it undermines the factors that contribute most to economic growth. And that's such things as investment, risk-taking, entrepreneurship, and productivity. And while it's easy to cartoon the rich as fat cats, America's rich are actually our successful entrepreneurs and business owners. And because of the growth in entrepreneurship over the past 30 years, there's actually more business income that's being taxed under the individual tax code than under the traditional corporate tax system. And so what that tells us is that cutting the top individual income tax rates for these dynamic individuals and entrepreneurs will lead to higher productivity gains, which then translate into higher economic growth. And let me wrap up by saying that with the deficit now at $1.5 trillion, it's tempting to look at closing loopholes and tax reform as an opportunity to raise more revenues for the government. But the primary goal of tax reform should be to promote long-term economic growth and to increase the living standards for all Americans, not just to raise tax revenues for the government. And if the byproduct of increased economic growth is more tax revenues, then that's a win-win. Now, I understand there's clearly a tension in the United States between the desire for a simpler tax code and one that also ensures fairness and equity. So I'd suggest that we develop a new way of thinking about equity in the tax code. We should strive to build a consensus around three basic concepts. First, an equitable tax system should be free of most of the credits and deductions and it shouldn't micromanage individual or business behavior. Secondly, an equitable tax system should apply a single flat rate on most everyone equally. And that way every citizen pays at least something to the basic cost of government. And lastly, an equitable tax code should be simple, and it should have dramatically lower rates than what we have today. In the low 20s, I think, by most accounts. And the government could raise about the same amount of revenue that it does today. I believe that such a tax code would actually generate a more predictable and stable revenue stream to fund government programs as opposed to the roller coaster system that we have today. And most importantly, such a tax code will be conducive to long-term economic growth and higher living standards for all Americans. And that is one of the keys of fixing the long-term fiscal crisis that's facing America today. And thank you very much. I appreciate the opportunity and would answer any questions that you have.
Thank you. Welcome back, Diane, a good friend and familiar face of the committee. Mike's yours.
Okay. I'm not used to being on this side. Chairman Ryan, Mr. Van Hollen, members of the committee, thank you for giving me the opportunity to testify before you today on the issue of pro-growth tax reform. I work for the Concord Coalition, a group that's been dedicated to the cause of fiscal responsibility for 2 decades now. As such, I feel that we can't consider tax reform in isolation from the rest of the federal budget, especially within this committee. That being said, my views that I express today are my own and not necessarily the official position of the Concord Coalition. This hearing is titled, The Case for Pro-Growth Tax Reform. Well, I think that's uncontroversial. I am for pro-growth tax reform as well as my other 2 colleagues here today. The issue, I think, is what exactly does a pro-growth tax reform look like? And it's not so simple. I think that we are used to hearing that all we have to do to fix our fiscal situation is grow the economy. And what it takes to grow the economy is lower taxes. But there's some causation that runs the other way too. And unfortunately that makes the challenge of creating a tax reform that's good for the budget a little more difficult. Tax cuts all have benefits. Everyone loves tax cuts. Tax cuts are going to benefit some business, some household. The problem is that when times are tight, like they are for us in terms of finding funds for the government to be able to conduct its business, when times are tough, we have to weigh costs against benefits. So just having benefits from tax cuts is not enough. We have to know that it passes a cost-benefit test. Here's a few reasons, a few basic reasons why it's not so easy to grow the economy by just cutting taxes and reducing revenues. The number one reason is because deficit-financed tax cuts, they're sort of like dig a hole into the ground first, and with the hope that we'll leap out of the hole from the growth that it produces from private sector activity. The hole that I'm talking about is the decrease in public saving. National saving is a sum of public plus private saving. So if you deficit finance a tax cut, you start with a negative change to public saving. So you have to hope that there's enough of a positive change in private saving to more than offset that in order to get a net increase in national saving. National saving is the key to supply-side longer-term economic growth. So that's why, unfortunately, there's a little bit, you start from a little hole, well, a pretty big hole, because it's a dollar-for-dollar decrease in public saving as soon as you deficit finance a tax cut. Second, how the taxes are cut matters. What matters for supply-side incentive effects are marginal tax rates. So the structure of the tax change you're contemplating really matters in terms of how much economic growth over the longer term in terms of aggregate supply in the economy can you expect. The problem is that a lot of our tax cuts have more of a cut in average tax rates rather than tax rates at the margin. If we cut taxes at the margin, we have to ask the question, how big are the incentive effects likely to be? There's a lot of uncertainty about that. A lot of households and businesses don't even react to marginal tax rates as much as they react to cash flow. And yet marginal tax rates and those incentive effects on labor supply and savings are what matters for the kind of growth that I think we're all hoping for. Third, in an economy recovering from a recession, the binding constraint in the economy in terms of making it bigger isn't the supply side of the economy, because we have plenty of productive capacity right now. The binding constraint is that we're not putting enough of that productive capacity to work. So it's a demand side constraint. So unfortunately, right now, we have to figure out how to increase the demand for goods and services first before we can start to worry about how the tax code can encourage labor supply and saving. Our experience with the Bush tax cuts, unfortunately, has demonstrated each of these challenges well. Because we deficit financed all of the Bush tax cuts, we've seen a huge decrease in national saving. Private saving did not increase dramatically to help offset that drop in public saving. Secondly, they haven't been very effective at increasing the supply side of the economy. We haven't seen big increases in the incentive for people to work or increase their personal saving. And third, the Bush tax cuts are really not a very good kind of tax cut in terms of short-term stimulus, in terms of providing a lot of increase in demand for goods and services. They don't have high bang per buck, as economists say. So if you look at CBO's list of the kinds of tax cuts that are most stimulative to demand, you'll find the Bush tax cuts are at the bottom of the list of tax cuts. Economists agree that the federal budget is on an unsustainable path, and that for the continued health of the economy, deficits must eventually come down. Even if we don't reduce deficits right away in the next couple years as we're still recovering, a credible plan to reduce deficits over the next 10 years is really essential, not just to long-term economic growth, but for the short-term stability of the economy, the confidence of our global investors. Tax policy has to be part of the solution. It is true that the greatest pressures on the federal budget over the next several decades are certainly in the entitlement programs. That's very easy to see. It's very easy to understand. Medicare and Social Security are programs that go largely to the retirement age population. The retirement age population is growing, and on top of that, per capita health costs are growing. So we all know that story. We all know that that's the driver of the long-term outlook. Unfortunately, it doesn't mean that we can't bring taxes into the solution just because they are not responsible for the bulk of the problems going forward. It is very difficult for me to imagine that our society would actually be willing to cut spending enough to keep taxes at as low of a level as they're at currently or even historically over the past 40 years. The historical average level of revenues to GDP has very little bearing on what the right level of revenues is going forward. And those who oppose raising revenue as a share of GDP are often convinced that this will increase the size of government. But I would urge you to look at the myriad of tax expenditures in our tax code that amount to over $1 trillion a year. And consider that, unfortunately, they're not just tax loopholes, but they're probably more appropriately considered tax entitlements. There are many policies. I'm going to urge you to stick to the current law baseline for revenue levels as a goal. As Mr. Van Hollen mentioned, that's way bigger than even a grand bargain would call for in the task of the super committee. But I urge you to set that as a goal because it would allow us to have some impetus for tax reform, for a revenue neutral type of tax reform relative to current law. If we wish to extend expiring tax rates, we can choose to extend that, but let's try to pay for it by base broadening or by finding spending cuts or revenue increases elsewhere. There are ways we can do it other than doing nothing. We can go the big route, which is fundamental tax reform. We can go the do it to the rich route, which is raise taxes only on the rich. But I think for the purposes of this committee, concerned today with pro-growth tax reform, what you want to do is focus on base broadening tax reform that can keep rates low and stick to something closer than current law revenue baseline. So I elaborate on these points in my written testimony, and I thank you for the opportunity, and I'm happy to take your questions.
Thank you, Diane. Appreciate it. If you could bring up chart 1 for me, please. So in thinking about all of this, I think it's interesting to just look at some of the economic data. I think we're beginning to achieve a consensus that lower rates are conducive to economic growth. Here is where we're headed in 2013 under current law. Current law has been proposed by the President and passed by the President. So our top rate's going, on the individual side, going from 35 up to effectively 44.8%. So we're seeing a steep increase, and as Mr. Hodge mentioned, the pass-through entities, sub-S's, LLCs, they're going to see a steep increase in the rates. Go to chart 2, please. And the thinking behind this is that the wealthy should pay their fair share, meaning pay more. Well, I think the evidence is pretty interesting here, which is take a look at the distribution of the tax burden before and after the 2001 tax cuts. In 2001, the top 1%, the top 5% paid less of the income tax burden than they do after those tax cuts. So looking at data from as a share of the tax burden with lower top marginal rates, the top 5%, the top 25%, the top 50%, the top 1% pay a larger portion of the tax burden than they did with higher income tax rates before those rates were reduced in 2001. I think that's just interesting data. Go to chart 3, please. And so when we take a look at the data from post-World War II on, what we find is our revenues as a percent of GDP are remarkably stable. It is income tax revenues as a percent of GDP, total tax revenues as a percent of GDP have been, pretty much level, but take a look at our top income tax brackets, our top income tax rates. So those income tax rates do not dramatically call for the change in revenues. Go to chart 4, please. What really drives it is economic growth. If the economy is growing, revenues are growing, even at these lower income tax rates. And what we've learned is lower income tax rates is conducive to higher growth and therefore higher revenues. We're not saying everything pays for itself. That's not the case. What we're also showing is the higher income earners actually bear a larger proportion of the tax burden when we go down that path. If you could go to chart 8. This is the one where I think there's got to be some area of bipartisan consensus here. This is the individual side. Who benefits from the quote-unquote loopholes or the tax shelters? Well, obviously, it's disproportionately to the side of the top 1%. The average is about $300,000 of those who are able to claim and benefit from shelters. So for every dollar that is parked in an income tax shelter, that is a dollar that is taxed at 0. If you take away the tax shelter but keep the rate really high, then we're hurting our economy from a competitive standpoint. But if you lower the rate and take away the loophole, that dollar that was parked in a shelter taxed at 0 is now taxed at something, and you get more income from that income source, from that taxpayer. So I think these are just interesting facts that ought to be worth considering. And so let me ask you, Mr. Wall, on the corporate side of things. From the perspective of job creators, which is more beneficial? Temporary measures that attempt to stimulate demand over the short term, or permanent reforms to incentivize and boost returns on job creation in places like Racine, Wisconsin, and throughout the U.S.? What do you think is better for your planning purposes as to whether or not to hire or not workers in Racine?
Thank you, Chairman. From our perspective as a business, we're looking for stable, permanent, pro-growth tax reform. Temporary incentives are temporary, as the name implies. When we look to make capital investments, we look at that return on investment, a 5-year cash flow analysis. Right now, there's so much uncertainty with the tax code. There's not a permanent structure to really make us make intelligent decisions on where we expand our operations. So to answer your question, temporary is not helpful for us. We're looking for permanent, stable, fundamental reform.
If we did, such as you suggest, bring our effective rate down to 25%, go territorial, would that encourage you to add jobs in your U.S. operations?
Absolutely. If you saw my written testimony, when you look, for CNH, we operate in 32 countries, and you see the comparative rates in my written testimony. Companies choose to expand operations a myriad of reasons or factors. Taxes is a significant component. The after-tax return on the earnings and the cash flow is an important consideration. So to your point, if the U.S. were to lower the rate to 25% and go to a territorial, it would be incentive for us to expand capacity in the United States and add jobs.
Ms. Rogers, let me ask you, because we talk about distribution so much these days, those calling for higher taxes tax rates often stress the need to make the wealthy, pay more, pay their fair share is how it usually is said. The top 3%, well, first of all, for instance, under the president's policies, deficits are set to rise by $9.5 trillion over the next 10 years, and that's the baseline. The top 3% of Americans by income, those earning $250,000 or more, which we know more than half are these businesses, they have a total annual income of about $2.3 trillion. Even if the government confiscated 100% of that income, it would only fund the government for about 6 months this year. So mathematically, is there any way to keep pace with current spending promises by just raising taxes on this group of taxpayers?
Mathematically, there possibly. I don't know. Economically, that would not be a wise strategy. I think that there's a tax policy center analysis that was very useful, done about a year or two ago, called Desperately Seeking Revenue. And in that analysis, the Tax Policy Center asked the question, what if we were trying to reduce the deficit to economically sustainable levels by just raising taxes on the rich? Okay, so you can take a look at that analysis. And what troubled me about that analysis was that if you just raised tax rates, if you were stuck with our tax base that's full of holes, which is a big qualification, I hope we don't have to be stuck with it. But if you were stuck with our, tax code that's full of tax expenditures, loopholes, preferences, you would have to raise marginal tax rates in the upper brackets to the 70 to 80 to 90% marginal tax rate level. Now, should we do that? No, I think all economists would say that's getting into dangerous territory. Even economists like me who I don't consider myself a supply side economist, but we're all supply side economists to some extent in that we believe that incentives at the margin matter. When you get to rates that high, the disincentive effects start to outweigh the positive benefits of getting more revenue and reducing the deficit. So I don't suggest that you go through it.
What I'm trying to get at,
strategy.
For instance, Dr. Orszag and Romer, after leaving the White House, have said that higher taxes on the middle class are inevitable. And so what I'm trying to get at is, are people being honest when they say we can keep pace with the current spending promises just by raising taxes on the rich?
In my opinion, I don't think they're being smart. I think that mathematically it's possible to raise taxes just on those people above $250,000 by just raising marginal tax rates. Do I think that that's the best way to do it? No.
Mr. Hodge, real quick, Mr. Van Haan and I are trying to keep our time limit so other members have time. Modeling. The rule of thumb around here with joint taxes, for every percentage point decrease in the corporate rate, it's about $10 billion a year on a static scoring basis. So a 10-year number, $100 billion per point. What do you think is more accurate from more sort of reality-based macroeconomic feedback models? What do you think the actual cost? Assume the base stays the same for sake of this. What do you think is more on the mark?
Far less, Mr. Chairman. I think that we're on the wrong side of the Laffer curve on the corporate tax rate. And that even if we were to bring our rate down to around the federal rate down to around 25%, which would still, when you add state taxes, be higher than the OECD average, I think it would be a net gain for the United States Treasury.
Okay. Thank you. Mr. Van Haan.
Thank you, Mr. Chairman. Just to the point you raised about the share that upper income earners pay, I would point out that the reason for that, the principal driving factor, is the huge growth in incomes of the folks at the very top relative to the stagnant wages in the middle class. That's what's driving the fact that folks at the very high end are paying proportionally more now. And if you look at the charts, it's almost off the charts. And that's an issue that I think we need to deal with from an economic point of view, because I think it actually has economic growth consequences as well as questions of tax fairness. Mr. Hodges, have you had a chance to look at the Simpson-Bowles tax reform proposal? I assume you have.
Yes, I have.
And what is your reaction to that?
I think it was a great document for moving the ball forward on both reforming some of our major entitlement programs as well as the tax system. I can pick nits with many of the specific proposals in there. I don't think that setting aside $80 billion a year in revenues from tax reform is the way to go. But I think in general principles, they did a fantastic job in moving the agenda forward in fundamental tax reform and entitlement reform.
Okay. Now, with respect to their proposal on tax reform, one of the recommendations they made as part of bringing down the rates was also to harmonize the rates for capital gains and ordinary income. I assume you're agreeing with that as part of an effort to bring down the rates.
I would not, Mr. Van Hollen. I believe that capital gains and dividends are a double taxation on corporate income. In fact, if you look at OECD data, specifically on dividend taxation, the United States has the fourth highest overall tax rate on dividends of OECD nations, and that's even after we've reduced individual rates over time. So I would prefer to keep taxes on capital lower and bring down those individual rates.
Well, that's interesting because the chairman made the point that the very wealthy benefit the most from these tax preferences and deductions. The primary reason the wealthy benefit most is because of the capital gains treatment right now. In fact, if you look at the others, you have a lot greater impact on middle income taxpayers. So if you take that off the table as part of tax reform and harmonizing the rates, you don't get one of the major benefits that the chairman just talked about with respect to tax reform. Let me, Mr. Wall, if I could ask you what's the effective corporate rate that your company pays right now?
The effective tax rate for Case New Holland in the United States is 39%. Okay. We generally are in the range of the high 30s.
Okay. Are you organized as an S corporation?
Oh, no, we're subchapter C corporation.
Yeah. Okay. Now, because I think there's a general agreement that the corporate tax rate in the United States at 35% needs to come down in order to be competitive. But I was also interested in your testimony. You talked about the importance of a number of the current deductions that are available. For example, the R&D tax credit and accelerated depreciation. So my question is, have you looked at the Simpson-Bowles proposals with respect to corporate tax rates? And what, if any, of the deductions in the tax code would you be willing to give up as part of an effort to do this in a revenue-neutral way, or maybe you think we should do it by adding to the deficit?
With respect to the Bowles-Simpson report, I have looked at it. The 23-29% rate that they're advocating, I think the 25 is the appropriate rate as my testimony. With respect to your question, which corporate tax expenditures should be modified in order to facilitate a 10% reduction in the rate, as I indicated in my written testimony, I think it should be done in a fiscally responsible manner. I haven't seen a legislation package, so it's very difficult for me to answer that question without seeing the totality of which corporate expenditures may be modified.
Well, see, this is always the rub. I mean, this is the rub. Everyone wants to talk about this in general concept, both on the corporate side and the individual side, about lowering the rates and expanding the base. But I'm just asking you as a businessman, since we should lower the rates, which I agree with, but I'm assuming you don't want to add to the deficits given where we are. Given your operations, which of the deductions would you be willing to get rid of? And if the answer is you need more time to look at it, I understand that. But that is that's what the Congress has to grapple with. And there are winners and losers in that. As we all know, GE, with huge profits, actually got tax rebates. So I actually, maybe Mr. Hodge, have you looked at the corporate tax proposals in Simpson-Bowles, and which deductions, if any, would you be willing to eliminate or preference?
Well, the Treasury did a sort of a thought experiment a few years ago, and they, in their thought experiment, eliminated all the corporate tax loopholes, and there are only about $100 billion a year in so-called loopholes for the corporate community, by the way, which is and the individual tax code has 9 times as much, so we're talking about a pretty small amount. And they found that you could only reduce the corporate tax rate from 35% to maybe about 28 or 29%, which takes the United States from having the second highest overall corporate tax rate down to about the fourth. So that's a lot of pain for very little gain. We need to go much further if we're going to cut the corporate rate down to a competitive level. And that means thinking outside of the box and moving away from a revenue neutral concept here and think more broadly. There are a number of provisions in the corporate tax code that should be eliminated, and whether it's subsidies for windmills and so forth. But I should say that if you look at the IRS data, the effective corporate tax rate in the United States on average over the last 18 years has been about 26% on domestic and foreign repatriated earnings. And that doesn't include the taxes that corporations pay abroad, which is about $100 billion a year. So their average overall effective tax rate is around 33% on average.
Just another question. First of all, I thought your testimony was very useful in making the point that when we're talking about S corporations, not C corporations, that you mentioned two facts. One is the Joint Tax Committee data, which shows that only 3% of taxpayers are in the category over $250,000, right? And you don't dispute that figure in your...
No, there are only 2% of all taxpayers
That's
have
right.
incomes above that amount, too.
Exactly.
So.
And you pointed out that despite the fact that there are only about 2 to 3% of taxpayers in that category, it does account for a huge amount of the income.
Yeah, that's our most successful private businesses.
But most of them are not what we would consider small businesses or mom and pops, right?
Nope.
Okay. No, I just think it's an important point because we often hear in this Congress that changes in those rates from 35 to say 39%, which is what, going back to 39%, which is what it was during the Clinton administration, would somehow be hurting all these mom and pop small businesses. But in fact, they include any businesses organized in an S corporation, which includes businesses like Price Waterhouse, KBR, Bechtel, right?
Many of those are organized as S corps.
Right.
Yeah.
So I mean, I just hope we'll put that aside and then we'll discuss it based on those. Now, it is also a fact that, you know, the 39% rate was in place during the Clinton administration beginning in the early 90s, and we obviously saw a booming economic period. I'm not arguing that somewhat higher, I'm not saying increasing marginal tax rates somehow generates economic activity. Of course it doesn't. Of course it doesn't. But the fact is there are a whole slew of factors that people take into consideration when they're making their decisions. And as the other testimony you heard suggests, I think, and the evidence and history suggests that small changes in those tax rates don't make a big difference. Now, here's what I want to just ask you in closing: the territorial issue versus. I'm going to read to you just an article from somebody who worked at Disney as a top executive, and maybe the two gentlemen could respond to this from the perspective of somebody who's in the business. And actually, if I could ask all three of our witnesses to respond. It says, I'm a card-carrying Republican who thinks that the deferral tax loophole is bad policy for two reasons. It rewards companies for moving property and jobs overseas, and it is unfair to corporations to keep jobs in the United States and then must shoulder a disproportionate share of the cost of government. It goes on to point out that GE's effective rate was 7.4%, well below the U.S. rate of 35%, largely because of shifting around with their foreign operations. And then I'm just going to read this paragraph and then ask you to respond. Now let's compare the Walt Disney Company, from which I retired in January. Disney is their most recent Form K shows an effective tax rate of 34.9%, dramatically higher than GE's. The reason is that unlike GE, Disney has kept its income-producing property and its jobs in the United States. Isn't one of the dangers of going to a sort of pure territorial system that a U.S. company, rather than investing here in the United States, would choose to take that same operation overseas at a much lower tax rate?
No. In fact, the global trends have been in just the opposite direction. The reason, actually, that the United Kingdom moved to a territorial system is because companies were moving out of their country. And when they started moving toward a territorial system, those companies started coming back. And the Japanese have found that, as I mentioned in my testimony, that their worldwide system created this lockout effect. Trillions of dollars worth of yen were being locked out of their country. When they moved to a territorial system, those yen started flowing back. And the reason that we have more than $1 trillion sitting offshore in corporate profits is because we have this Berlin Wall that's been created by the worldwide system.
I know my time is up, but the point that he was making was that you can address that issue by getting rid of the relaxed deferral agreement. In other words, that's his point.
Deferral?
That was his point. And taking the I know my time.
It will put U.S. companies at a disadvantage, and the harmful effect on U.S. jobs will be immediate.
I guess in the interest of time, I'm going
we got a lot of
to
members.
ask the others. I'll talk to you afterwards. Thank you.
Mr. Garrett.
Thank you. Mr. Hodge, with regard to your corporate tax code, currently you said we're at number 1 or number 2 as far as corporate tax rates or tax burden?
Tax rate.
Tax rates, okay.
Tax rate. The top marginal rate of 35% added to the state rate puts us over 39%, which is the second highest in the.
So the pushback to that often is, well, we may be at the first or second in the top rate, but we're not necessarily at the top top burden because of all the corporate loopholes that are out there. So how do we compare vis-a-vis the other countries as far as our overall corporate burden when you consider the fact that you have $100 billion worth of corporate loopholes?
Well, the $100 billion actually doesn't lower the effective rate all that much. As I mentioned, over the last 18 years, it's been about the average effective rate for all U.S. corporations has been about 26%. And then when you add the taxes that they pay abroad, which is about $100 billion a year, their global world effective tax rate is about 33%. So they are paying close to the U.S. Statutory rate.
Well, did you say if you did away with them all, you would go all the way down to?
You can only lower the rate maybe to about 28 or 29%, and that includes bonus depreciation, which we would not want to eliminate.
Okay, and so if we did that, then our standing in the world would be approximately?
We'd be 4th highest around in the OECD.
Okay, as far as rates are concerned, but burden level basically remains the same because it's one shift to the other.
Right. I mean, the U.S. is about 3% or 4% of GDP is in corporate tax collections is below the OECD average. That's true.
Okay.
And so we have a high rate and low collections, which makes a lot of sense. That's why we have this Neiman Marcus system. You know, Neiman Marcus is very small, Walmart is very big, and then they're doing it on volume, whereas Neiman Marcus is trying to do it on price, and you can see who won.
Okay. So, okay, thank you. Going to one of the Chairman's initially comments, he was commenting what the President said, we do need to do corporate tax code reform, which is a good thing. The President spoke of, I think you said, fairness, simpler and more competitive. Mm-hmm. Now, there was an article, I think, a week or two ago in National Review on this topic of competition and competitiveness, and there's too much focus on competitiveness, and I may not be saying exactly correctly, but the focus should not be to try to make our system more competitive, but rather our economy more competitive, rather more productive. Because you could have a more competitive system simply by switching the tax code around to say that Mr. Wall's business is more competitive vis-a-vis international trade by giving you additional corporate benefits or tax cuts, what have you. You're now more competitive versus your trading outside this country. But that's really not what we're trying to do here, right? We really need to not have competition, but increase the productivity for your company, right?
Well, I think that by lowering the rate, we will increase productivity. And so by making the U.S. more competitive, U.S. companies will become more productive and more competitive as well. Mm-hmm. So what's good for the economy will be good for them as well.
Okay. And Ms. Rogers, you were making the comment as far as what we need with overall as far as our budget is concerned is some certainty, even if not to be made now with regard to cost savings because of the economic morass that we're in, but over the long period of time. And if you provide that certainty over the long period of time, that will provide what? More productivity and investment in the economy now?
Well, I think it's important to get our budget outlook in control for the short term just because it increases the confidence of global investors in the U.S. economy and keeps interest rates low.
But I thought you said something about that maybe not making those cuts right now, but rather as long as you have a plan in place that over a period of time, so that provides a certainty. Maybe I heard you wrong.
No, that's right. I mean, you might be surprised that the Concord Coalition, who are, the deficit hawk organization, isn't demanding that deficits be cut right now, but we're not. We're demanding fiscal responsibility right now, which might mean whatever deficit spending we're doing at the moment that we make sure it has high productivity, high bang per buck in terms of the stimulus, and over the longer term that we've got a plan in place to get to more economically sustainable deficits.
Well, so two quick questions. One is there any history to show that if we make any projections now for the future, as far as not making the cuts today, but plan to do them in the future, that they actually get implemented?
No, we're not. We don't have a good track record on that, and that's why I'm hoping that the Budget Committee can commit to some serious budget discipline rules, such as strict pay-as-you-go.
And the second thing, as far as the short-term fixes that we do right now, both parties have done this. President Bush did this with a tax package where we got, sent out checks basically of $250 or something like that to family. The new administration is saying the same thing. Let's do some short-term tax fixes as far as payroll taxes, what have you. What's the history? Whether Republican or Democrats try to do this, do you see long-term results from this, or are they just really blips in the economy of that period?
Well, I don't think that the payroll tax cut is designed to be a long-term growth tax cut. It is designed to stimulate demand. So the reason why CBO lists payroll tax cuts as one of the more effective tax cuts to increase demand is because it tends to go to lower and middle income households who are most cash constrained. So if you're trying to get more spending on goods and services immediately, you're best giving the cash to people who are constrained and will spend it all when they get it.
Mr. Blumenauer.
Thank you. Thank you, Mr. Chairman. I always find these conversations interesting, how they shift over time. I'm not persuaded that the tax rates are the drivers when we look at how the economy performed so much better in era of higher taxes on business and, in fact, on individual rates. I think we would lust after economic productivity improvements that we saw, and we're involved with the 10-year experiment when we cut Ronald Reagan's Ronald Reagan harmonized capital gains. We've been involved in a 10-year experiment, and it hasn't produced stellar economic results. But I want to focus just on three items. One, dealing with the complexity. We talk about the tax loopholes only being $100 billion. But it seems to me that they contribute to a much higher cost. We've been told, by this committee, we've been told before Ways and Means, it's $162 billion a year to comply with the tax system that we have now. And the leakage through evasion or purposeful forgetting or just that complexity is a couple $100 billion every year. So those two numbers combine far exceed what our super committee friends are arm wrestling over for the next 10 years. $3.5 trillion, you'd be happy people. And we'd be breathing easier and the economy would be working better. I'm looking at two items that may get us a little faster and would look for brief response because I don't have much time. The first deals with the value-added tax because those countries you're talking about that have lower statutory rates collect a lot of business income through a value-added tax and in fact pay more in overall tax than business in the United States and all but I think one of those countries. What is your reaction to a value-added tax to kind of level the playing field and maybe buy some corporate tax reform? Any interest on any of the three of you?
I'll take that one first. I think eventually we are headed toward needing to consider new tax bases, including an add-on value-added tax, maybe carbon-based taxation. But I think that the first step in leveling the playing field of taxation is to look at the existing income tax code. So I think there's plenty of room to broaden the tax base, even it out.
I want to just zero in on the other two gentlemen very briefly. Any interest in exploring a value-added tax as a way to buy it down?
If the corporate income tax could be eliminated altogether, lie poured on it so it didn't grow back up, then I would consider a value-added tax.
Congressman, my comments on that would be, as you can see where we operate, most of the jurisdictions we operate do have a VAT. I think it's important to note the United States has a consumption-based tax at the state level, the sales and use tax. We'd be happy to look at any type of reform proposal that may include that in order to achieve fundamental corporate tax reform.
Thank you. let me put one other item on the table, because there's one area in terms of user fees that would make a huge difference. And right now, we are beefing up our transportation trust fund. We've transferred $35 billion of general fund into it because it's in a downward spiral, and it's about to really collapse with electric vehicles, with hyper-efficient diesel. Simpson-Bowles suggested raising the gas tax. A gas tax has been part of the Ronald Reagan. He actually signed a nickel a gallon in 82. The Clinton 1993 had a gas tax. We've had the petrochemical tax on Superfund expire, and so that cost has been shifted to private business. Any interest in looking at user fees to try and fill some of this gap?
Sure. Yeah.
I prefer to see the Highway Trust Fund turned back over to the states, along with the taxing authority to be able to fund it.
The scope of my testimony is on corporate tax reform, so on a user fee at the individual, it's beyond the scope of I'll comment on.
Mr. Chairman, I would hope, in fact, you've received a request to you and Mr. Van Hollen from Mr. Simpson and myself to perhaps have a little attention to user fees, the Highway Trust Fund. That is a deficit that is yawning and is going to create bigger problems in the future. We would really hope that we may be able to...
Happy to work with you. We've got a pretty busy fall schedule, but we're definitely happy to work with you, just like this hearing was originated at the request of Mr. Van Hollen.
Super. Thank you, Mr. Chairman.
Calvin. Thank you, Mr. Chairman. I'd like to focus a little bit on the backbone of America's economy, our small business community, or what exists of it today. As you know, small businesses provide 55% of all jobs in the private sector, produce roughly half of the privately generated GDP of this country. It doesn't take rocket science to understand that when small businesses grow and succeed, the entire economy as a whole benefits, including revenue. As a person who actually was in small business, you know, how you define small business in this country, I can tell you any smart business plan takes into account the current economic outlook, tax and regulation policy when you guide your decision process about how you're going to invest, how you're going to spend, and how many people you're going to hire. And as we all know, their current outlook in the country on business is dismal, especially in California, where I come from. And I believe the administration's tax policies are in effect contributing to a lack of confidence in the small business community, because you can't make long-term decisions based upon knowing that taxes are going to be increasing in 2013 and other costs. In fact, according to the National Federation of Independent Businesses, their August report, the Small Business Optimism Index fell the 6th month in a row, and only 11% of small businesses plan on hiring new workers over the next 3 months. I think that's about as low as it's ever been historically. Nearly 75% of small businesses pay taxes under the individual income tax system. Tax hikes aimed supposedly at the rich, as proposed by the Obama administration, would end up hurting successful small businesses, because roughly 50% of these small business profits are taxed at the top 2 individual tax rates. These questions are for everybody. Do you think raising taxes on these small businesses is the right strategy in a slow growth, high unemployment economy? And secondly, what are some of the best ways we can provide confidence and certainty to the small business community through tax reform? And I look at regulations as a form of tax also. You know, when we look at these increasing regulations, taxing these small businesses in order to comply to these oncoming regulations. So we'll start off the gentleman from Case.
Thank you, Congressman. With respect to your specific question on pass-throughs, subchapter S corporations, partnerships, as you can see from our written testimony, we have 1,300 suppliers and dealers that do operate as pass-throughs. From our perspective, we would not want to see more stress on our suppliers. My testimony also talks about there's some discussion on whether or not we should treat pass-through entities as Subchapter C corporations subject to the double taxation regime. We would not think that's advised.
Can I ask a question to you gentlemen on your suppliers? How many of your suppliers have gone bankrupt in the last 2 years?
Congressman, I don't have the exact number, but we've suffered suppliers going bankrupt. There's been a number.
Thank you.
The other, I mean, you got two questions there. One was in terms of confidence, I would say, in my testimony, in terms of small business, I think tax reform, that certainty is really what we need, some stable, certain, fundamental tax reform. And in terms of regulation, I mean, I know we all read the paper, we look at the National Labor Relations Board, EPA. I do commend the Congress administration for looking closer at the regulatory burden, but that is, I believe, creating a crisis of confidence in the corporate community.
Mr. Hodge?
Congressman, one of the things that sets our economy apart and our country apart from every other country is the dynamism of our non-corporate or pass-through sector, all of these private business owners. And as I mentioned in my testimony, more than half of all business income in America is now being taxed under the individual tax code. And as you mentioned, a lot of that is at the top marginal rate. And so by increasing taxes on those more dynamic entrepreneurs and businesses, I think would have a chilling effect on the economy for the long term. And it's just the opposite of what we should be doing. And according to all the economic research, including that of the OECD, looking across all countries, cutting those rates is the way to go right now and the way to spur those dynamic companies and to improve the overall dynamism of the country.
I would just caution that while cash flow is needed by everyone in the economy right now, it's got to come from somewhere. And if we deficit finance tax cuts right now, it doesn't remove its cost. So the immediate cost is the drop in public saving, the increase in the deficit. If you care about long-term growth, that's going to offset any benefit you get from increased private sector activity over the longer term.
I just make a point, Mr. Chairman. Cash flow is a nice concept. I know a lot of businesses today that have a negative cash flow. They're going out of business, as the gentleman from Case pointed out. Bankruptcies are record high in this country. So,
thank you. Mr. Honda.
There it goes. Thank you, Mr. Chairman and Ranking Member Van Hollen. And thank you to our witnesses also for being here today. You know, the irony of the challenges posed by our debt and deficits is that if Congress did nothing and allowed the current law to run its course, the deficit would be reduced by over $4 trillion. And this would mean bringing rates roughly back to where they were during the Clinton presidency, a period when the economy added over 20 million jobs and recreated a budget surplus. My question to Ms. Rogers is that it's been argued by my Republican colleagues that the only way to grow the economy is to cut rates even further. If this is true, then why is it that the country prospered under Clinton's rates, and how would you explain that?
I was actually on the Council of Economic Advisors the last year of the Clinton administration, and I wrote the section of his economic report that talked about the merits of fiscal responsibility. One thing we learned about the Clinton-era tax increases is that while we were a little bit worried that that might have some adverse effect on private incentives to work and save, in the end, the increase in public saving far outweighed any slight decrease in private saving. It was very minimal, the adverse effect on the private sector. So the net result was an increase in national saving, and national saving is the key driver to longer-term economic growth. So that's the simple reason why, even though marginal tax rate increases do have a dampening effect on labor supply and saving, we didn't see very much. Empirically, it turned out that that effect was very small relative to the increase in public saving, the reduction of deficits that turned to surpluses. That was very good for the economy.
So following up on that, the term fiscal responsibility seems to have been said by each of the witnesses. In your definition, how would you define fiscal responsibility?
My definition of fiscal responsibility is getting the most we can out of the resources that we have in our economy, both publicly and privately. And so fiscal responsibility in the short term, in terms of the government sector, means that while we're trying to support the still recovering economy, we're trying to get the most out of our money so that we're devoting our resources toward policies that will increase demand by a lot relative to their cost. Over the longer term, we need to come up with policies that reduce the deficit, but are also favorable to economic incentives. So keeping marginal rates low by broadening the base, you can still raise revenue without hurting incentives for the economy to grow.
So, following up on that, if we were allowed to allow the current law to run its course, could we start on that path again?
That is an option. I've said that there are 3 ways to stick to the current law revenue baseline. 1, do nothing. 2, do it big. Do fundamental tax reform that broadens the base if you want to pay to retain some of the Bush tax rates. And 3, do it just to the rich. You know, raise marginal tax rates only on the rich. Those are 3 options or any combination, and it's up to Congress to figure out what you can tolerate. All of them are taxing revenue increases, is the point.
Okay, thank you.
Well, even less than time. Mr. Price.
Thank you, Mr.
Dr.
Chairman.
Price.
Thank you, and I want to thank the panelists as well. I think this is a helpful conversation and discussion. We're all interested in pro-growth policies. We have a difference of opinion about what results in growth in the economy. Ms. Rogers, I'm struggling a bit with this payroll tax notion. You voiced support for decreasing the payroll tax, supporting the President's proposal for decreasing it on employers and employees. I understand. Is that right?
I label it a relatively effective tax cut for increasing demand for goods and services.
And that the payroll tax that's being paid by employers and employees that's referred to in these discussions, what is that money used for?
Well, it goes to the Social Security Trust Fund. But this is a transfer. If the payroll tax cut would be financed with the rest of the budget. So it's a deficit finance tax cut.
So, and I just heard you say that you don't support deficit financing for tax cuts.
That's right. So I like the President's proposal to offset the cost by broadening the tax base.
By increasing taxes.
By broadening the tax base and increasing effective tax rates, but without increasing marginal tax rates.
Okay. I think it's important to point out that this payroll tax cut that's being talked about by the President and others is actually a shift. It's just a shift in who's paying for the Social Security benefits.
Well, it's a shift in the tax burden. You're right, temporary shift in the tax burden. But actually, we could do a revenue-neutral shift in the tax burden. Not that I'm proposing this, but if you just took, if you raise taxes on the rich and cut taxes on the poor, that would actually be stimulative to the economy. That's not what I'm proposing to do, but I'm just illustrating the fact that you can keep average tax rates constant and redistribute the tax burden and actually achieve one result in the short term, maybe a different result in the longer term.
Actually, that's more consistent with what our budget did that we passed through this committee and through the House as we broadened the base and lowered the rates for all. I want to move on to the issue of territorial taxation because I think this is incredibly important. And Mr. Wall, you mentioned that you're in Wisconsin. So overseas to you isn't overseas, is it? Is it just over the border?
Correct.
So competition that businesses see in states such as yours have to look to what the rate is in Canada and decide whether or not you're going to house a facility in Wisconsin or Canada, correct?
That's an excellent point, Congressman. When you look at in my testimony, the countries that we operate in, as I mentioned before, when we look to expand capacity, it's a myriad of factors. Taxes is one of them. Logistical costs is another. When you're shipping large tractors and combines halfway across the ocean, you can imagine logistical costs are very high. But with respect to your specific point, you could put capacity in Canada,
yes,
and shipping southbound wouldn't eat you up on logistical cost.
Right, and it's a whole lot easier, and their tax rate right now is about 10% less than ours. And
that's exactly right.
Yeah. Mr. Hodge, I was interested in your comments about a consumption tax, and you appended your statement to say that if we did away with corporate income tax, that you would be supportive of a VAT tax. It isn't a consumption tax like a national retail sales tax. If we do away with all income tax for both individuals and corporations, isn't that a way to truly invigorate the economy by aligning our taxation with our form of commerce?
Well, most economists would agree that we want to move toward a consumption base in our tax system, and there are many ways that we can do that. You can do it through an end-stage retail sales tax. You can do it with a value-added tax, but also a flat tax, like a Steve Forbes-style flat tax, is also a consumption tax because it's removed savings and investment from the tax base. So there are many ways you can sort of skin the consumption tax cat and get there. I would be more preferential to a flat tax than moving toward a VAT because I think that there is many problems with that as we see in sales taxes at the state level. But we should certainly be moving away from income-based taxes toward a consumption base.
And let me revisit the territorial issue with you as well, because you said that actually having a territorial system of taxation increases business activity here. Can you expand on that and why that is?
I'm sorry, say it again?
That having a territorial taxation increases business activity, would increase business activity in the United States.
Well, it would lead first and foremost to a great deal of repatriation of foreign profits that are now trapped abroad, and that companies are reluctant to bring back to the United States to pay this enormous toll charge that we've set up to bring their own money back and invest in the United States. So I think that moving toward a territorial system would bring a flood of dollars back to the United States that could be invested here, creating jobs and R&D and what have you. It's their money, but we've set up such a toll system for them to bring it back that the incentives are just simply in the wrong direction.
Thank you. Thank you, Mr. Chairman.
Thank you, Dr. Price. And like we often say in Wisconsin overseas, we refer to Lake Superior. Yeah. So,
Illinois.
A Minnesotan. Get back at me. Ms. Schwartz.
Okay, thank you. I appreciate this conversation. I wanted to bring it back to what I think is, in some ways, a bit of a broader view about tax policy as we go forward. I think it was said by each of you that we're pro-growth. We think that economic growth is certainly very important to get ourselves out of where we are right now, but we need to understand what that takes and to understand, I think, that the context within which other issues we're dealing with. I think it was Ms. Lynn Rodgers who actually talked about the deficit reduction and the need for fiscal responsibility. So we can't really, I would say, not talk about corporate taxes or even individual tax reform without an understanding of this broader context of the need for revenue and the need to reduce the deficit. Certainly the concept that if we just lower taxes for the wealthy, particularly for wealthy corporations, that will in fact create jobs, which is, I think, Mr. Hodge's point very clearly. If in fact that had worked, we would not be in the situation we are in. And so the concerns I would have about the notion that the unpaid for tax breaks that were given during the last decade, the Bush tax cuts as we refer to them, that were tax cuts for the wealthy, tax breaks for corporations, that they would produce jobs, just failed to materialize. The fact that there were large unpaid for tax cuts did not lead to job creation. The last decade has given us a staggering wage stagnation, which has made a very big difference to consumer demand, which of course industry needs, because if consumers aren't buying your products, you don't make them. So that has had huge consequences. The excessive, the lack of consumer spending, and now of course the excessive borrowing that consumers are now saying I can't do anymore, which is a good thing, has actually created incredible stagnation in the economy. You could add to that the political uncertainty, the almost default on our debts created uncertainty in the investor community. Investor confidence went to essentially zero. August, we had a stunning turnaround from what we had seen as job growth over the last year and a half of new jobs every month to zero jobs because the investor community, the corporate Americans, the people who produce jobs said, we can't risk it. We don't know what's going to happen if, in fact, we're going to potentially see a government default on our international loans. So my question, particularly given what I've just heard from particularly Mr. Hodge and Mr. Ryan, that the answer to this is to reduce corporate taxes, and in fact, Mr. Ryan suggested quite deliberately, and I think that Mr. Hodge did as well, the answer is to increase taxes for the middle class, that individual tax rates, eliminating tax provisions of deductions, for example. I think Mr. Ryan suggested that we might reduce he would suggest that we reduce tax benefits for savings, retirement savings, that would be a way to pay for the lowering of the corporate tax rate, seems to be exactly the wrong way to go. And I support lowering the corporate tax rate and broadening it, getting rid of the special interest loopholes that in fact may do no good anymore and are certainly not stimulating the economy. So my question is, in fact, and I'll address this to Ms. Lim Rogers, is it important for us to look at tax reform in the context of deficit reduction, in the context of how do we give middle-class Americans more dollars to create that consumer demand so you can actually make products and sell it to them, and that we, as we look at corporate tax rates and the international competitiveness, that we do that again in the context of what creates jobs in the short term. Great New York Times article this morning about the President's jobs package leading to potentially 2% additional economic growth and a couple million jobs. That's not something to put aside. So what can we do both in looking at the short-term demands for job creation, the requirements for fiscal responsibility, and the requirement of additional revenue as part of the way we get out of the debt we're in. If you could, in just a little less than a minute, give us your opinion about whether that's the right context to be looking at this.
Well, I think we absolutely have to be talking about the deficit, effects on the deficit, even in the short term. I think that it's possible to broaden the tax base without overly burdening middle-class households. Just because we are talking about looking at the tax expenditures within the individual income tax, and those benefit all income taxpayers, not just the rich, it doesn't mean we have to eliminate those tax expenditures. There are ways of limiting those tax expenditures in ways that are very progressive. So the President's proposal to limit itemized deductions to 28% is an example of how you could pare back on some tax expenditures without burdening the middle class.
Thank you.
Thank you. Mr. Langford.
Thank you. Witnesses, thank you all for being here. This is very helpful, and it's a good conversation for us to have in a bipartisan manner to be able to talk through the issues. This is something we kick around a lot on the floor and a lot in the hallways, and to be able to determine what does that mean by dealing with tax code and tax policy and broadening the base and lowering the rates, and all these things are great terms, but getting a chance to walk through some of the dynamics of that with y'all is very helpful. So I appreciate the time that y'all put into doing this. Let me continue on a conversation that has already started on the issue of repatriation. And I have multiple questions on this, and I've not had the opportunity to be able to hear your comments on that. What are your initial comments on the territorial versus global system? And then in two issues, and I'm going to come back to everybody on this, and one is the 1 year or 2 year repatriation, or just wiping it out completely and just moving to a completely territorial system versus global system on how we handle international business earnings.
So on international and corporate tax reform, I think it follows the same principles as with the rest of the tax system, in that if we're talking about ways to reduce the effective rate of taxation on businesses, we have to worry about what's happening to revenue levels. We can't just count on the growth to make up for the loss of revenue.
No, let me just clarify, because I just want to have a conversation with this back and forth. That is assuming those companies are going to bring those assets back at some point, and they'll be taxed to the 35% rate or whatever rate it is. So is that what you're counting as a loss? Is the assumption they will eventually bring it back, or is the assumption they made that money in Canada, they're going to leave in Canada, it's never coming back? Which one's your assumption on that?
Well, probably somewhere in between. I mean, whenever we give a tax break to do anything, there's some incentive for the business to do what it is we're encouraging them to do. We don't know what their response is going to be. And so, and part of that lower tax receipt is a response to, businesses shifting activities toward lower tax activities. So some of that tax cut is going to take effect in the form of lower revenue, and we have to worry about that.
So would it be better to leave the higher rate and just let it play out and allow companies that have investments overseas to leave it overseas? Maybe they'll bring it back, maybe they'll leave it there, but just to allow it the same rate. Is that your recommendation?
I don't know. I don't want to make a recommendation on that proposal. I just want to caution that we don't, that it sounds to me like that is narrowing the tax base or reducing taxes, and we have to worry about whether it's worth its cost.
Okay, thank you. It's fair enough. Ms. Hodge.
Well, I think we can learn some experience here from both Great Britain and Japan, which are the two largest and most recent countries to move to a territorial system, and for two very different reasons. One, Great Britain was actually seeing the flight of companies leaving Great Britain because they had a high corporate rate and a worldwide system. So they left to Ireland and Switzerland and Netherlands to seek some relief from that. And the minute they moved toward a worldwide or a territorial system, they saw some of those companies intending to come back to Great Britain. Japan had a very different experience, as I mentioned earlier. They saw this locking out effect, of which their worldwide system was keeping profits abroad, largely in Asia, some here in the United States. And when they moved to a territorial system, they saw some of those profits starting to come back to Japan. I think we suffer many of the same consequences that both of those countries are seeing, and that's the reason we ought to move very, very swiftly to a territorial system so that we can unlock that locking in effect that's trapping all of those profits abroad that should be here and invested in the United States.
Okay, let me make a couple follow-up statements back and forth. Several months ago, Timothy Geithner was actually seated in that same seat. We had the same conversation. I know, you're sitting in the Secretary's chair. We had the same conversation about territorial taxation or global taxation. The President had been very impassioned in his State of the Union address, had dealt with corporate taxes, about lowering the rate, broadening the base, but had not talked about territorial versus global. I asked the Secretary about that. He did not give me an answer one direction or another on a preference on that. And that was an interesting dialogue to me, and I'm still yet to be able to hear from the administration a perspective on that. I don't know if anyone has heard the administration to be able to state a perspective on this other than just lowering the rate and broadening the base. The issue comes down to what we were just talking about before. Is it a loss of tax revenues to be able to deal with the repatriation issue? Number one, and let me go ahead and skip to the number two on that. Is it better to do just permanent, or is it better to say, until we can get to permanent, let's do a 1 or 2 year repatriation, just exemption?
Well, I'm always reluctant to support any sort of temporary measures, because I think whether it's temporary back-to-school sales tax holidays or payroll tax holidays, that's bad tax policy. It creates uncertainty in the tax system, and it violates most of our principles of tax policy. But the sooner that we move to a territorial system, the better off the U.S. economy will be, and the more competitive U.S. businesses will be.
Okay, thank you. Mr. Chairman, I yield back. And Mr. Wall, I apologize for running out of time on that. Thank you.
No problem.
Hey, Ms. Moore. Okay. Move up a few seats. Let's see if that works. I don't know what that's never happened here before. You guys got any ideas?
Try this one.
Gwen, do you mind just moving back a seat? That's all right.
Yeah, a little too well.
I get to be Debbie Wasserman Schultz for a moment. I want to thank each and every one of you for your appearance here today. I, in particular, want to thank Mr. Wall for being here. I've had many meals from the Case Company. My father worked there for 40-something years. Uncles worked there for several years, and I have a great affection for the Case Company. And I want to thank Mr. Hodge for being here and Dr. Rogers for being here as well. Let me get right into my questioning with Mr. Wall. You are pushing for this territorial system, and apparently Mr. Hodge thinks this is a good system as well. I guess my question would be, first of all, how much of this $3 trillion, we hear about $3 or $4 trillion that companies have sitting on the side, how much would you say that Case has sitting on the side waiting for tax certainty?
Thank you, Congresswoman. I think it's important to give a brief background.
I don't want you to take up all my time.
I'll be very brief then.
I want the number, the amount of money.
Insignificant. Our structure is we have a handful of corporations beneath the United States. We're foreign investment in the United States. So when I advocate territorial, It's not a significant benefit for our company. To me, it's sound, prudent tax policy, which is why I put it in my written testimony.
Okay, thank you so much. Mr. Hodge, I am really grateful to you for the $500 per child tax credit that you indicate that you pushed for in the contract with the people during the Newt Gingrich era. We all have seen reports as recently as today or yesterday that 1 in 6 people are poor in America. So I'm wondering how your view of consumption-based tax or a flat-based tax, how do you think that will fare on the poor? And indeed, children are the poorest population, poorest among the population. How does that square with your view that we ought to move toward more consumption-based taxes?
Well, I think you probably know that about half of all Americans now pay no income taxes, and many of those people actually get refundable tax credits through things like the $500. In fact, we're giving out about a little over $100 billion in refundable tax credits this year to people who pay no income tax. So that's actually a larger amount than all the corporate loopholes combined.
Okay, so that's what I'm saying. So if 1 in 6 people are poor and they have to consume, they have to buy bread and washers and dryers, and they have to have stoves and refrigerators. How would a consumption-based tax, do you think, how would they fare under that proposal? Would they not be more poor people? If we were to move to a flatter tax?
I don't think consumption taxes would drive people into poverty, but poor people anyone who consumes anything would pay a sales tax to the consumption.
Thank you very much. I want, Mr. Wall, I want you to respond to Dr. Rogers' indication that if we were to move to a territorial system, that we couldn't be certain whether or not those dollars would actually be used to invest here in the United States. We'd lose the revenue, but there'd be no certainty. We'd have no match. There would be no certainty that those monies would be used for investment. Like now, money's sitting on the sideline, and corporations are profitable, but they're not reinvesting. So what could you say to that point?
Congressman, my response would be, as Mr. Hodge indicated, the lockout effect, the trillions of dollars. Companies, if there was a repatriation holiday or whatever Congress deemed appropriate, money would come back, and companies are in the business of investing that money.
Thank you. Dr. Rogers, I have not been for the just tax the rich thing. I say we ought to let all of the Bush-era tax cuts expire. Get rid of all of them. Can you respond to that, Economist mom?
Well, yeah, I kind of agree with you, but that I'm speaking on my own behalf when I say that. The Bush tax cuts have a cost over 10 years of over $2.5 trillion without counting interest costs.
And they don't help the poor as much as they do the rich.
That's right, and that doesn't count the AMT relief that we've needed to pass every year to offset some of the effects of the Bush tax cuts. So put those together, and the CBO says that's $4 trillion over 10 years.
It would solve our problems right now.
Without interest.
Get over George W. Bush.
Well, or either, I mean, what I've been trying to stress is that sticking to that current law baseline doesn't require that we stick to current law. So if there are parts of the Bush tax cuts that both Democrats and Republicans like and want to keep, what it suggests is we should just try to find a way to pay for it. If we really want to keep them, they must be worth offsetting its costs with some other types of base broadening tax reform.
Thank you, Dr. Rogers. Thank you, Ms. Moore. Mr. Ribble.
Thank you, Mr. Chairman. Ranking Member Van Hollen, thank you for calling for the hearing this morning. Mr. Waltz, good to see you. I'm from Green Bay. Feel free to expand up in the 8th District anytime you like.
No problem.
And so it's good to be here. Ms. Rogers, was it last December that the Bush rates were extended?
Yes.
So it's really the Obama rates, correct?
They're you can call them the Bush-Obama tax cuts now. That's okay with me.
Thank you very much.
I've talked about them that way, in fact.
I mean, we seem to reinvent history here. Those rates were extended under President Obama most recently. And so I do want to ask Mr. Hodge a question, though. You mentioned in your testimony that the tax code ought to be simple transparent and equitable. Those were the three words I think used. Am I describing it accurately?
Well, I don't, not equitable. I talked about a new way of looking at equity, but the tax code should be transparent, should be simple. It should be neutral to economic decision making.
Okay. This is the tax code, roughly 10,000 pages here. Would you say it's simple?
No, we've actually used that as a doorstop.
I've been using it as a paperweight in my office, but Mr. Rogers, would you call it simple?
No.
Mr. Wall?
It's not simple.
It seems to me that every time Congress strikes, and I've only been here 9 months, so I don't have all the historical perspective on how we got here, but it just seems like every time Congress decides to simplify it, we add 500 or 600 pages of complexity. Is that kind of how you see it too, Mr. Wall?
Yes, Congressman.
Yeah. Mr. Hodge?
Absolutely.
Ms. Rogers?
Yeah.
Yeah. And that's my fear, is that we're going to kind of nibble around the edges here, not really do any real true tax reform, and we're going to end up, in an effort to simplify something, make something more complex, more inequitable, more difficult for Americans to figure it all out. It just costs a god-awful amount of money for most Americans to even file their tax returns. Now, I can't even imagine what it's like for a company like yours. But there's a tax on a tax because of it. Who pays corporate taxes? I mean, where do you get the money to pay those corporate taxes from? You borrow it, or where do you get that money?
Corporate tax is levied out of the company's profits. I mean,
So
it's a
you get
tax
your
on
profits
labor, it's a
from-
tax on capital formation.
So you get those profits from selling product.
Absolutely.
And those profits build in the taxes into the cost of the products. So would you sell your products for less money if your taxes were at a lower rate?
If our taxes were at a lower rate, in terms of the market advantage, probably.
Yeah. I mean, at the end of the day, for the most part, really consumers pay all taxes. Every dollar of tax is paid by consumers. You're going to pass it on. I mean, I ran my own roofing company for years and years, and roofing costs more when taxes are higher and costs less when taxes are lower. Mr. Hodge, looking at the flat rate that you mentioned, equitable tax system should apply a single flat rate on most everyone equally. That way, every citizen pays at least something toward the basic cost of government. I think Representative Moore makes a valid question here, not so much on the consumption side, but on a flat tax rate. How would you structure a flat tax rate so as to not penalize low-income or poor families?
Well, let me just premise that by saying I think we have too many people right now who are not paying any income taxes whatsoever and thus not contributing to the basic cost of government. They are consuming government, they're reaping great benefits from it, but they're not contributing to it. And I think that's a problem both fiscally and also for our nation's democracy, to have more people benefit from government than are actually contributing to it. And there are many ways that you could protect the poor. You could have like we do have a standard deduction and so forth, but we have simply knocked too many people off the tax rolls in recent years. The tax code has always protected the very poor. That goes back to 1913. But I do think right now we have too many people who are paying nothing and contributing nothing to the cost of government, and actually they're getting a check back from the IRS. They are looking at April 15th as payday rather than tax day.
Okay. Thank you very much, and thank you all three of you for spending some time with us this morning. Mr. Chairman, I'll yield back.
Mr. Dockett's gone. Mr. Pascarell.
Thank you, Mr. Chairman. Mr. Chairman, I want to commend you and Mr. Van Holland and the witnesses today and both sides of the aisle for what I consider to be one of the most civil discussions about a very serious topic. Neither party is privy to virtue on what we're trying to do. In the book that was held up before by the gentleman from Wisconsin, what percentage of that tax code is there to protect the very 2 or 3% of the people we're talking about at the top of the scale? They have hundreds and hundreds of attorneys. The average guy, like you or like me, somewhat, they don't have any lawyers to deal with these things. And I think that's something we ought to address. We're talking about increasing the number of pages in the tax book over the years. Every president said was going to shrink it. Every Congress was going to shrink it. It only got worse. Because they're a lot smarter than we are. Those lawyers have gotten all kinds of concessions. And unless we address that. And you know what, Mr. Chairman? I got to give the Tea Party credit. As your wing of the party. We have our wings. You have your wings. And they brought this subject, if they only understood all the facts rather than just having blinders on, I think they would understand what we're dealing with, and that is that the rich got richer and the poor got poorer. That's an oversimplification, Mr. Chairman, but that is true. My friend from Oklahoma, who talked about repatriation, we tried this in 2004. 105, 110 companies. Chamber Watch in April of this year was very specific about the fact no jobs were created. None. Zero. In fact, of those 105 major companies who took advantage of the repatriation with 5.25% coming back on tax on what was coming back into this country, many of them had tax cuts. Not only did they had tax cuts, they cut jobs. So we need to put things in context and see how these things, really turn out. Now, the other side, your side, Mr. Chairman, cut taxes in 2000, we're leading, we joined you in some of them. Tax cuts in 2000, 2001, 2003, made predictions, just like Mr. Obama made predictions in his team, both of them totally wrong, about what was going to happen if we cut taxes in 2001, 2003, how many jobs would be created. You had to create 5 million jobs, and we know it was less than half of that. Both sides don't know what they're talking about. And I'd rather listen to the people in this room than the folks from Yale or Harvard who've been giving the advice over the last 12 years. I can learn more in this room, God bless you, in terms of boots on the ground, than I can learn from any of those folks that we've been listening to. We've got the protocol and the models wrong. And I want to ask, and if you look back into the Financial Times at their series of articles back in 2003, you'll see what was predicted and what really came out. And that is why it's very disappointing. And Democrats obviously were happy that they didn't create the jobs. I'm being cynical now, back in 2001, 2003. And just as many folks on your side hopefully do not see an increase in jobs, and we'll get that guy in the White House, whatever it takes. I'd rather listen to the folks in this room, Mr. Chairman. Now, Mr. Rogers. Today, I think, contrary to common perception, federal taxes at the lowest level in over 50 years. Federal, state, and local income taxes, and by the way, Mr. Hodge, you may not like it that, let's say, 50% of the people don't pay income tax, but you take a look at all the other federal taxes that those people pay. Look at it in context, and they pay a higher percentage of what they're worth than those people who are paying income taxes. Please put it in context. Please put it in context. Those people pay other federal taxes. Do they not, Mr. Hodge? Do they or don't they?
They do, but it's a much
Do you know
smaller...
how much the percentage of what they're worth it is?
Actually, people in the lowest tax bracket, or including all of their taxes, are in negative tax effective tax rates.
Because when you include the income tax.
When you include the refundable
well, that's not what I asked you.
Thank you, Mr. Pastor. On that sunny bipartisan note, we'll turn it over to Mr. Huelskamp.
Thank you, Mr. Chairman. I appreciate the opportunity to ask a few questions of folks, and I want to come to Mr. Wall for the last question because I want to hear from someone outside the room that is actually in the world of creating jobs. So I particularly appreciate your testimony so far. One of the first comments and observations I'd like to make and ask a question of Ms. Rogers is you were talking about sticking to the current baseline by the estimates out of my office on January 1st, 2013. if, as Mr. Van Hollen indicated, if we Congress took a 10-year vacation and did nothing, we would have about $5 trillion of tax increases over the next decade. That's the current baseline if nothing changes. And I don't know if you've, do you still support a sticking to the current baseline and as far as its impact potentially on the economy, a $5 trillion tax increase, that's good for the economy?
I think it's needed for the economy, for both the medium term and the longer term, and I think that it doesn't require reverting to Clinton-era tax rates, despite the fact that I don't think that those were very bad for the economy kinds of tax rates. I think that it's an opportunity to commit to a strict version of pay-as-you-go rules, and which is just to say whatever you want to keep in terms of extending tax cuts, you pay for them. Because right now in current law, we have committed to an expiration of all of the Bush-Obama tax cuts at the end of 2012. So I'm just asking that this committee and Congress more generally commit to pay-as-you-go.
But you don't believe the president should commit to pay-as-you-go on his payroll tax proposals. Is that correct?
No, I support the idea of offsetting the cost of those as well.
That is not, and I read the bill last night, and there is no offset. Essentially, it's borrowing money, debt payments is what will be the offset. There is no offset in the president's bill. It's borrow and pay later. It's not pay as you go. And but question I would ask, we have a $5 trillion tax increase potentially facing us if we don't make some progress here. I appreciate the discussion today. But Mr. Wall, the question I would have for you, and as you talked about certainty and temporary tax cuts, temporary tax relief, temporary measures as we've seen in Obama Stimulus 1, Bush Stimulus 1, Obama Stimulus 2, is how many years do you need to say, hey, that's the kind of certainty I need? And my problem is, as a member of Congress and everybody here, is we can't bind future Congresses. We can try to tie them down, maybe with a constitutional amendment on the balanced budget amendment. But how many years do you need of certainty to say, hey, yeah, I can make those investment decisions?
Thank you, Congressman. With respect to your question, I would say permanent. What I'm advocating is not the temporary stimulus, if you will, permanent, stable, fundamental corporate tax reform. We talked about the corporate taxes was waged on capital formation, labor, and customers. The corporations have the jobs. If the tax rate could be lowered, when you look at our competitors, the OECD, it would stimulate investment into the United States. I think that would be huge for investment and job creation.
So if by some political miracle, and maybe I'm not optimistic enough, the House Republican budget that presumes fundamental tax reform would pass and become law, this is the only chamber that's actually suggested that if it becomes permanent in this year or sometimes before January 2013, you'd think that's good enough signal that a future Congress could come in on sometime in the next year or two or three or four or five, make changes again. But if you were told, we've passed it, it's hopefully going to stick, that would be permanent enough for you, because that's the problem. They can change it in 2 years.
That's absolutely right. I mean, we would need the message that it is stable, it's permanent, and the regulatory, the other side of the equation I mentioned in my written testimony, regulatory reform, that the burden of regulation is loosened up. That's the type of message I think that would instill corporate confidence.
Okay. Appreciate that. And Mr. Hodge, I appreciate you being here as well. What's your expectation of what would happen if we fully implemented the Obama stimulus plan number 2? How many jobs would that create in your best guess?
Few, if any. Jobs are not created on temporary measures. They're created on long-term expectations, as we've been discussing. And right now, the long-term expectations of the business community looking at the economy is very, very poor. Mm-hmm. And I doubt that even a small incentive would encourage someone to hire someone who could cost tens of thousands of dollars over a long term. If you get a $5,000 tax credit to hire a $25,000 a year worker, that person is going to cost $125,000 over the next 5 years. So that incentive is really relatively small for that long-term commitment. And so you ought to be absolutely sure that you have profits and business that's going to allow you to keep that person for the long term. And right now, too few businesses have that certainty.
Yep. Well, thank you for the conference, Mr. Chairman and Ranking Member. I appreciate a great panel today.
Thanks, Ms. McCollum.
Thank you, and thank you, Mr. Chairman, for the temperature in this room so you and I don't feel so homesick. It is freezing in here. I just want to kind of go back and I think kind of demystify what some of the conversation's been about, what people pay for income taxes, who pays and who doesn't pay. And I'm going to give my cite. The data is from the Tax Foundation. And it shows that in 2008, the average income from the bottom half of taxpayers was $15,300. This year, the first $9,350 of income is exempt from taxes for singles, and is $18,700 for married couples. That's slightly more than in 2008. And that means millions of the poor do not make enough money to owe income taxes. It's not a question that they've decided not to pay income taxes. Many of them don't make enough money to pay to owe income taxes. And as was pointed out, they do still pay plenty of other taxes. Federal payroll tax, which right now is a holiday for them, so that's the stimulative effect that Dr. Rogers was talking about. They pay gas tax. They're paying sales tax in their states. They're paying utility taxes and other taxes that they have no choice. They have no discretion. If you have water, if you have electric, if there's a utility tax on it, they're paying it. And then when it comes to state and local taxes, the poor bear an even heavier burden than the rich in every state except Vermont. And that's the Institute of Taxation and Economic Policy that did the calculation on the data. That's not my numbers or anything that's been cooked up. The other thing I wanted to, just before I ask my question, it's been alluded to, but I really this just troubles me. We throw out our good neighbor to the north, Canada. We talk about our strong ally in Asia, Japan. And when we talk about these economic comparisons, we're not talking about how they are fundamentally structured and function different within their business communities. In Canada, businesses don't have the burden of health care the way that your business does here. In Japan, the government decides it's going to work with its businesses to do R&D, and by golly, they're going to have the best battery technology in the world, and they help their corporations do it. So when we just kind of start throwing out countries, and Germany does the same thing, we sometimes shorthand things to make it work for the argument that we have. But here's my question. I'm very concerned, and I did not vote for the Bush tax cuts. I didn't vote for the Obama tax cuts, because I just thought we were too rosy with the scenario about what was going on out there, and there was too much uncertainty and too much unpredictability. And here's my problem. I'm willing to cut. I'm willing to cut into programs that I think really make a difference in investing in our future, but we need to do something about our deficit. But what bothers me is when we talk about the income taxes in particular, it's okay to go out and borrow the money on those. So my question is to the panel, do you have anything that shows, anything at all, any studies that support the notion that tax cuts at this magnitude are ever going to pay for themselves that will help reduce the deficit, or are we just going to continue to make no investments in our future? And we'll start with Ms. Rogers and work down.
No, I mean, I actually don't think any economist would claim that the tax cuts would pay for themselves. So it has a cost, in other words, so we have to weigh the cost against the benefit. And I think you bring up an important point, which is that we have to start considering not do we like the tax cuts, but do we like them better than alternative uses of that money, because it's a lot of money, and there are a lot of investments that government could make or other forms of spending they could make. And we should be weighing those trade-offs instead of just saying we like the tax cuts and we'd rather keep them than lose them.
I'd be happy to share with you some OECD research looking at the experience of other countries in cutting their corporate taxes while broadening their bases, and they find that
Mr. Hodge, that goes to my point. What are those companies putting into R&D? What are those countries doing for health care? So I think we need a balanced approach when we talk about that. So if you could, if that includes everything, and I'd love to see it.
Well, it's looking at what this research is looking at what are the revenue losses from corporate tax reform, and they find out that generally speaking, that these kinds of corporate tax reductions don't lose as much money for the Treasury as were expected. For some reasons, it's because of the base broadening, and others because.
Mr. Hodge, I was referring to the individual income tax when I talked about the tax cuts.
I think that we should be broadening the base as we lower individual rates as well. I mean, we have there's $900 billion worth of tax expenditures in the individual code. I don't think all of them should be eliminated, but many of them can while we cut those rates. I'll be the first to start clicking off the tax expenditures we can eliminate.
Thank you. Mr. Woodall.
Thank you, Mr. Chairman. And thank you all for being here. Mr. Hodge, thank you for the time you've invested in us in tax policy over the years in the 7th District of Georgia. I appreciate that. Dr. Rogers, do you think it's important for everybody to have skin in the game? You talked a lot about incentives and that somewhere up there on the margin, high rates matter. They affect people's incentives. Low rates, I would argue, also matter. Do we, to keep this American experiment alive, do we all need skin in the game, or is it okay to move folks off the tax rolls?
I personally would prefer that that most people be on the tax rolls, but we already all have skin in the game in one way or another. I mean, I think that focusing our attention just on who pays federal income taxes is it's a little bit of a narrow view of who has skin in the game, because there are opportunity costs of how we use our funds, and so in a sense we all have skin in the game.
I absolutely agree with you. I think we spend much too much time talking about the income tax. Payroll tax is the largest tax that 80% of American families pay, and we spend very little time talking about that. Though when we talk about looking at all of those stages, I look at the CBO's report, for example, on effective tax rates. I mean, to the point my colleagues were making earlier, yes, according to the CBO, the two bottom quintiles in America have a negative income tax rate. They do have a 4% effective tax rate, but only because the CBO believes that the payroll tax that corporations pay on their employees' behalf is actually a cost to the employee, only because the CBO believes that corporate income taxes are a cost to the consumer. And making both of those conclusions, folks still have skin in the game. Do you share those conclusions, that when we tax corporations with a payroll tax, that's really a cost to workers, and when we have that corporate income tax, that really goes lots of different places, but goes partially to consumer costs as well? So
the way CBO constructs effective tax rates is it assigns the burden of any tax to ultimately a real person. So you can tax corporations in a legal sense. You can tax businesses in a legal sense. But ultimately, it has to be traced down to some real person, an individual in a household that bears the burden. It can be bearing the burden because you're the employee of a firm that pays the taxes. It could be because you're the purchaser of a product that corporation makes. Or it could be because it's an income tax directly on the household. So all CBO does is make certain assumptions based on empirical research about the demand and supply in certain markets to assign the burden to certain households.
So it all comes back to the only taxpayer we have in this country.
Is real people. Real people,
right.
Yeah.
I'm always been interested in a symposium the Joint Tax Committee did back in 1997 that you participated in. I think you were the non-supply sider there, trying to represent, they tried to bring in an entire spectrum of
Actually,
folks.
I had a model that was very much a supply side model.
It was the Fullerton, what they call it?
The Fullerton-Rogers model.
What I thought was interesting, and for folks who haven't ever looked at that symposium, Joint Tax was trying to figure out how to model a consumption tax economy, because they just didn't have a model that could handle fundamental tax reform like the fair tax, for example. Economists don't always agree on a lot, but what I thought was interesting about the 8 of those groups that participated with you in that study is that absolutely every group said, if we moved to a consumption tax model from our current model, the economy would grow faster.
I mean, that was the one thing you all agreed on. You differed on whether capital stock would grow a little or a lot. You differed on the labor effects. But every single group agreed that under a consumption tax, the economy would grow faster.
Can I explain a little bit of that, though? One thing we learned from that experiment was that when you move from our current income tax system to a broad-based consumption tax, you do get a lot of benefits from what you get a lot of benefits from is mostly the broader base, more than the switch from an income tax base to a consumption tax base.
Though even the unified income tax that you also modeled that broadened the base did not report the same kind of growth that the consumption tax modeled with that.
That's true. Base. That's true.
Now, with my last 15 seconds, Mr. Wall, one of your big competitors, AGCO, is in my district, so I'm interested in your industry succeeding, and I'm interested in what one of my colleagues asked you earlier. Here we have the president proposing about $500 billion worth of stimulative policy, in his words. Is it your position that, however it is that we would distribute that kind of volume of money, something temporary, less valuable to you than something permanent? We live in a give it to me now economy, but you're saying give me something smaller that's permanent rather than something big that's right now.
Congressman, we're in Georgia as well. But with respect to your question, permanent, stable tax reform. These temporary incentives are not helpful in terms of when we look at investment and return.
Thank you.
Mr. Yarmouth.
Thank you, Mr. Chairman. Thanks to all the witnesses. About 4 or 5 months ago, I represent Louisville, Kentucky, and we hosted, through the Chamber of Commerce in Louisville, a White House Business Roundtable. There were 35 to 40 business people there, anywhere ranging from Humana to an individual restaurant owner. And for an hour and a half or so, they sat around and talked about what the federal government should do to stimulate the economy and job growth. And in the course of that time, they talked about funding community colleges, investing in infrastructure, investing in R&D, other education spending, immigration reform. Only one person in that entire hour and a half from all those companies mentioned taxes, and he asked a question about property taxes. So obviously the federal government wasn't involved. Parenthetically, nobody also mentioned regulation changes. My question to any of you, particularly Mr. Wall, is why do you think that was the case?
Why the gentleman mentioned the property
Why not
taxes?
one of them in an hour and a half, 35 or 40 people, ever mentioned taxes?
Obviously, I can't answer for those gentlemen. Our view is, when we look to invest, it's a myriad of circumstances or factors, and taxes is a significant component. So
fine. I don't know why they didn't either, but they didn't. Now, there's been a conversation, many people have mentioned it, this issue of planning and how hard it is to plan your business if you're a subchapter S, for instance, and if the rate may go from 35% to 39.6. I had this conversation with a constituent of mine. I asked him, is that the biggest variable in your business, that you can't plan for the potential increase of 39.6? You know that's the outside that he's going to pay, and that all the rest of the variables in your business are more predictable than that? Would you say that in your business that all the rest of the variables in your business are more than essentially 10% in your tax rate?
to your point, the other variables in our business are more variable than the taxes. But I think an important point, when my CFO asked me to do a discounted cash flow on an investment, it's a 5-year window, and I give them an asterisk saying that assumes the tax rate's going to be this. So,
but it wouldn't be hard to assume that your tax rate's going to be a maximum of 39.6, and that gives you some parameters, wouldn't it, if you're planning a business?
That's correct. When you do analysis, we look at statutory rates.
Thanks. Dr. Rogers, you mentioned in response to Mr. Honda's question, you mentioned that use the term empirically as to why jobs did not, or job growth was phenomenal when rates were higher. Do I take that answer to mean that there are a lot of factors other than taxes that determine whether taxes actually resulted in higher or lower taxes resulted in another effect? that a higher tax rate could have a very different effect under certain other circumstances or a different effect under other circumstances? Is that really the gist of what you were saying?
Yes. Economists talk about taxes having two sorts of effects on economic behavior. There's an effect because you're changing relative prices, that if you cut rates on certain forms of activity relative to others, that you encourage people to substitute into those lower tax activities. But then there are always income effects too as well, which says, what are you doing to people's real incomes? So if you're cutting taxes, you're making them feel better off. If you're raising taxes, you make them feel worse off. And we change our behavior. Everyone changes their behavior if you have more income or less income.
Right.
So it's hard to predict.
Right. Well, I'm going to tell a little story, which is a true story. I have a brother who's in the barbecue restaurant business, Sonny's Barbecue. I'll give him a plug. I'm an investor, I have to disclose, although I don't make the business decisions. And my brother was always Republican because he didn't want to pay as much tax. And back in 2008, he called me and said, you know, John, I've decided to support President Obama this year and all Democrats. And I said, well, that's great, Bob. What was your epiphany? And he said, I finally decided that if nobody can afford barbecue, it doesn't matter what my tax rate is. And he will tell you to this day that a marginal tax rate change of something of the magnitude that's being discussed, and he's a subchapter S, is the last thing he considers in making a business decision. He wants to know whether he can make more money, and then he'll worry about how much taxes he pays. And he pays at the highest rate. So I throw that out just to validate what you said. Thank you very much, Mr. Chairman.
Thank you, Mr. McClintock.
Thank you, Mr. Chairman. Mr. Hodge, we talk about taxes and deficits as if they're polar opposites. But aren't they really identical twins? Isn't a deficit simply a future tax?
Indeed it is, and we're borrowing from our kids to the tune of about $1.5 trillion a year, which by definition will mean they'll pay higher taxes.
Dr. Rogers, would you agree with that?
Yes.
Aren't taxes and deficits merely the only two possible ways to pay for spending? Is there any other way to pay for spending other than a tax or a future tax?
I suppose you could monetize, or if the Fed could monetize it, but
well, but even that is a tax on the economy, is it not?
Right. Yes.
It's a tax on those holding dollars by reducing the value of the dollars that they hold.
Mm-hmm.
So those are the only two. So we're dealing then with identical twins here. It's not the question of taxes or deficits. It's a question of spending. I mean, with apologies to the Clinton campaign, it's the spending stupid. We look at the Bush and Clinton administrations and the different approaches they took. Clinton raised tax rates, Bush cut them. The difference, though, I think, is Bush, while he was cutting tax rates, was also increasing federal spending dramatically by an astonishing 2% of GDP. Clinton, while he was raising taxes, was also cutting spending by a breathtaking 3% of GDP. When we look at all of these economic models, and I share Mr. Pascrell's concern that the modeling seems to have been wrong, we ought to be looking at our own experience. Herbert Hoover increased spending dramatically, increased tax rates dramatically, didn't work out well. Roosevelt did the same thing, didn't work out well. Harry S. Truman slashed taxes dramatically, slashed government spending even more dramatically, and we had the whole post-war economic boom. And we can go through each of the administrations. It seems to me that it is the spending stupid. Your thoughts?
I believe that we are spending far more than we can ever pay for, and I don't believe that current tax policy can ever keep up with this level of spending, especially health care spending. And I've looked at some of the European experience with value-added taxes, and those value-added taxes are not growing fast enough to pay for their health care spending nor their future entitlements. So they're having to raise those rates as well, and even that's not enough. Tax revenues will not really grow any faster than the economy, and so if you have government programs that are growing at 3 or 4 or 5 times the rate of economic growth, your tax revenues will never catch up.
So revenue is very important, but the healthy way of generating revenue is through economic growth. And in fact, the only source of revenue is prosperity, is it not?
Indeed.
Mr. Ribble touched on this. I wanted to amplify it a little bit. Who pays business taxes?
Well, well, business taxes are paid by people in the same way that people pay tobacco taxes. Cigarettes don't pay tobacco taxes.
It seems to me that business taxes can only be paid in one of three ways.
Yeah.
By consumers through higher prices, through
workers,
employees through lower wages,
and shareholders.
Or by investors through lower earnings. Those are the 401ks.
That's right.
So really, isn't it the middle class that bears all of the business tax increases that we've been talking about?
Well, all workers, to some extent, bear the cost of corporate income taxes. And what we learned in a global economy where capital is very mobile but workers aren't, that workers are increasingly bearing the largest share of corporate taxes.
So when you increase the tax burden in any way on a business, ultimately it's paid for by consumers, by employees, or by investors, mainly 401ks.
That's correct.
We've looked at the enormous amount of money that we spend through the tax codes to bribe people to make decisions that they wouldn't make if they were making them on their own. Just our office came up with about $1.3 trillion when you include everything. Isn't that distorting the economy? Isn't that sending dollars to their less productive use?
There's an incredible amount of what we call deadweight loss because of all of this in the economy.
So shouldn't we be doing away with those, but at the same time reducing the overall tax rates to assure that those taxes aren't passed on to a middle class that is reeling under the economy?
We need to free up all of those wasted resources that are now going to either tax preparers or these unproductive activities.
One more quick question on the payroll tax. The tax cuts in December didn't affect the tax rates. They maintained the tax rates in place. The change was the payroll tax cut. Has that helped the economy?
I don't believe so.
Who are we next? Ms. Castor. You mind just sitting where Gwen was?
There we go. Thank you very much. Thank you, Mr. Chairman and Ranking Member Van Hollen, for calling this hearing on tax fairness, because I don't think folks at home believe there is much fairness in the tax code right now. They see it as Swiss cheese. They look up at Washington and they think that the special interests, folks who have the money to hire lobbyists, have been able to carry the day, and that they're not, those big special interests are not paying their fair share, while they're law-abiding citizens just trying to get by and pay the bills and pay their taxes in a fair way. One of the things I'm hearing often is how can it be that the big oil companies, especially that are making the highest profits in the history of the globe, are receiving taxpayer subsidies. So American taxpayers are actually subsidizing, in this day and age of growing debt and deficits, that American taxpayers are having to subsidize those industries. And I know my GOP colleagues have supported that, have guarded that, but at the same time we see American jobs going wanting. And this, frankly, could be put to better use by investing in a robust jobs plan. But just so we put some numbers behind it, over the next 10 years, American taxpayers are scheduled to pay oil and gas companies more than $40 billion. That's just to the Big Five alone, and the Big Five have reported over $1 trillion in collective profits over the past 10 years. Now, the President's Bipartisan Fiscal Commission observed that the corporate income tax is riddled with special interest tax breaks and subsidies that are badly in need of reform. And I would hold this up as the poster child for reform. These most lucrative companies should not be receiving taxpayer subsidies, especially when the future deficits are projected to be so high. And the GOP has put Medicare on the table to end Medicare as we know it. That's not fair, and that's not passing the smell test at home. The fastest and most effective way to reduce the deficit is to put people back to work and address tax fairness, and failing to address this job situation will compound our economic weakness and our debt and deficit. So I'd like to ask you, okay, if we know we've got to move forward and combine a robust jobs plan with greater fairness in the tax code by eliminating these special interest loopholes, First of all, tell me, if you had to pick one initiative to create jobs, what would it be? Right now, if you said this would be the most effective in creating jobs right away.
From my perspective, Congresswoman, fundamental tax reform. I mean, we talked about the special interest loopholes. A lot of those are corporate tax expenditures legislated by Congress to initiate certain economic activity. I'm for simplification, bringing down the rate and reducing the expenditures in a fiscally responsible manner.
Okay, thank you.
I would concur with that. I think fundamental tax reform, both bringing down both corporate and individual rates while broadening the base, will do the most for the long-term health of the economy. Ultimately, that results in greater job creation.
Okay. Dr. Rogers.
I would ask the Congressional Budget Office to come up with a list of whether it be spending increases or tax cuts that are most stimulative to demand. And I would pursue the ones at the top of that list, whether they be spending increases or tax cuts. And I would commit to pay for it by letting some of the high-end Bush tax cuts or all of the Bush tax cuts expire in the future.
Okay, so as part of job creation, you're pointing us back to the unfairness in the tax code. So I've highlighted one special interest loophole that can go with these growing debt, the one for the big oil companies, $40 billion over the next 10 years. Name another one. Give us some guidance. Give us another loophole, tax expenditure that could be closed.
Congressman, as I said before, it's very difficult for me to say that without seeing the totality of the package of what expenditures Congress...
Do you have a favorite out there? How about the gory video games? I mean, we believe in R&D and that's tax credit, but do we cross a line where American taxpayers are subsidizing these violent, gory video games? You can't name one other?
I think, as I said, Congresswoman, to me, I'm for simplification, bringing down the rate, and eliminating the expenditures.
I would eliminate all the tax so-called subsidies for renewable energy, windmills, solar panels, all of that. Actually, there's about four times...
And the big oil?
There's four times as much tax benefits for renewable energy right now than there is for the, quote, big oil. And actually, I would eliminate, along with that, the tax expenditure for tax-free municipal bonds. And there's about 10 times as much benefits going to municipal governments right now through the tax code than there is through big oil.
Thank you.
Okay.
Ms. Black.
Thank you, Mr. Chairman, and again, panelists, thank you for being here today. I know we're a little bit over our time, and thank you, Chairman and Ranking Member, for allowing me to get my question in here. As we're talking about fundamental tax reform, I have been trying to understand, because it is a very complicated code, as was seen by Congressman Ribble's book here, that it is quite complicated. But I want to go to the nomenclature, because we keep hearing words that are not defined. And in particular, let me go to just what was talked about by Ms. Castor, and when we're looking at definitions of whether a subsidy is the same as a tax credit, as a loophole, as a tax expenditure, as a deduction. Can each of you tell me what is the difference between the subsidy and what I think, if you take all those other words, the tax credit, loophole, expenditures, and deductions, they seem to be in one pot and the subsidy seems to be in another. Can you give me a clear definition? Are all these the same? Are they just synonymous, or do they really have a difference?
Many of our so-called tax expenditures, which are the special preferences in the tax code, are subsidies that encourage economic activity to be shifted into those sectors that face lower effective tax rates through the complications in the tax code. So I define a subsidy as something that gives a preferential rate, effective tax rate, to certain industries or certain types of households or certain forms of income or certain ways of using income.
So is a child tax credit the same as a child subsidy? Is that the same?
Boy, it doesn't come close to really subsidizing the cost of having children. So, but it does reduce tax burdens. It's not what I would call a subsidy in terms of shifting resources into particular sectors of the economy.
Mr. Hodge.
Well, certainly the child tax credit was not intended to incentivize anything. It was just purely family tax relief. But a lot of whether we call something a subsidy, a credit, or a deduction depends upon what your ideal tax base is. And for many of us, things like the tax deductions for savings and so forth, capital gains preferences are not considered subsidies because we believe that those shouldn't be taxed in the first place in our ideal tax base. So a lot of it does come down to what you believe the ideal is, but there are clearly too many things in the tax code that are intended to incentivize or benefit certain industries over others, and that's clearly a violation of tax principles.
Mr. Wall?
Congresswoman, the nomenclature that's used is corporate tax expenditures, in my view, is Congress legislating incentives to encourage certain type of behavior. Section 199, encourage domestic manufacturing. So I use the terminology incentive.
Okay. I do think, Mr. Chairman, that maybe that would be something good for us to have is a list of some of these definitions of the words that we throw around so that we have a very clear idea about what we're really talking about. And I know that I have very little time left, but I want to go to another group that we continue to hear. And yet I don't know that I know for sure what the definitions of that really is when we talk about the rich or the wealthy, or millionaires or billionaires, or poor. What do we have clear definitions that fit into the current code so that as we do reform, that we can have a clear idea about definitions of those words as well?
Well, there's no standard definition for who is rich or middle class.
Okay, so when we hear folks talk about taxing the rich or the wealthy, I mean, millionaires and billionaires are a little easier to define. If you're a millionaire, you're a millionaire. You're a billionaire, we can say, here's your income, we know that. But when we talk about the rich, when we talk about the wealthy, when we talk about the poor, it seems that it sets up a lot of emotional feelings and brings about feelings on whichever side, class warfare or someone feeling like they're being singled out, they've been successful. And again, definitions here don't seem to be clear as we move forward of how we reform our tax code in knowing rich, poor, wealthy, whatever. Mr. Hodge, you want to speak to that really quickly? I know we don't have much time.
I think we need to make a distinction between middle class and middle income. Middle class is a value system in which about 99% of all Americans believe that they're in. The middle income is a narrow definition of what middle income is. But most of us believe, and I think most of us rightly think of ourselves as middle class, and that's a whole different thing.
Mr. Wall, I think, well,
thank you.
Mr. Chairman, I guess I'm out of
Lunch is
time.
coming up.
Thank you.
Ms. Capter.
Thank you, Mr. Chairman. What America really needs is a pro-jobs in the U.S. tax reform effort. From the figures I have, and I'm going to put some of these on the record, it's been a great year for corporate America. Caterpillar's second quarter earnings shot up 44% to $1 billion. General Electric's second quarter earnings were up 21%, $3.75 billion. Mr. Wall, Case New Holland has been no exception. Your company had another great quarter. Posted in July, profits show your net sales grew by 24%, and you brought in net sales of $4.9 billion. I mean, you got to be proud of that. If we look at big oil, it's the same. BP made $5.6 billion. Chevron's profits $7.7 billion. Exxon another $10.7 billion. Now, we are told that these companies are the job creators. So my question is, where are the jobs being created? Last month, there was zero private sector job growth. According to the Bureau of Labor Statistics, there are 3.2 million job openings, different kinds, around our country, but 14 to 24 million people who are unemployed, who are discouraged, or working 3 part-time jobs, and frankly, burned out. I have these people that I represent. I meet them all the time. We're being told now we need to cut taxes on companies despite their robust earnings and their disinterest in hiring in our country. Maybe some of the witnesses missed the reporting recently that GE paid nothing in taxes. And I must question, how do you cut taxes of companies that pay nothing? This is a really interesting math problem. So I think the system is somewhat unfair to the average citizen, in fact, very unfair. And it's unfair to small businesses and those who do pay their fair share. Tax avoidance isn't just a factor of one company. In 2009 and 10, the 6 largest banks that brought America's economy down, including Goldman Sachs, Wells Fargo, Bank of America, and J.P. Morgan Chase, paid an effective tax of 11% of their pre-tax earnings. And Goldman raked in $9.6 billion in profit. Its CEO received $64 million in compensation. He's willing to admit Jamie Dimon at J.P. Morgan Chase earned $70.3 million as his bank raked in over $17 billion. Yet we live in a world where fund managers like Warren Buffett point out they pay at a lower tax rate than their secretaries. Mr. Hodge, in your testimony, you claim we should lower U.S. statutory tax rates for corporations. I assume you acknowledge the great disparity between what a few companies on Wall Street pay and the tax rates paid by small businesses in places like I represent. Would you support an effective tax rate where those companies would pay the same, the largest financial firms, the GEs of the world, as Bayer Hardware pays in my district, or the bakery, Strawn Bakery, all these different companies? I assume you're not arguing that those who've learned to not pay their fair share should be rewarded by allowing them to do so. And then you can wait a second to answer that question. Mr. Wall, I noticed that your company employs over 10,000 people, and I hope you agree that job creation needs to be our #1 priority. Your company's CEO testified before the House Transportation and Infrastructure Committee last year that every $1 billion spent on infrastructure projects by the government creates about 18,000 jobs. Do you agree with your company's assessment? Do you believe we need to take on the deficit by growing the economy through investment in infrastructure and useful public works? So first, Mr. Hodge, please.
Well, thank you, Congresswoman. I don't believe that General Electric represents corporate America any more than I think Leona Helmsley represents all of us. There are always going to be taxpayers, private, personal, corporate, that can configure themselves in such a way to minimize their tax burden. But I can look at the overall IRS data. In fact, the Tax Foundation released a study last week looking at actual corporate IRS data, and we find that the effective tax rate for all corporations in America over the last 18 years has averaged around 26%. That's after taking all their credits and deductions and loopholes and everything else. And that doesn't count the taxes that they pay abroad.
Does that include hedge funds, sir?
It includes all corporations.
Don't they pay at 11% rate?
I cannot speak to how they, in some cases, some hedge funds may pay, if you're talking about carried interest, which is a capital gain, they are paying at the 15% capital gains rate. But, you know, we have to distinguish.
I got a hardware in my neighborhood, they pay at a 35% rate. What's fair about that?
That's the statutory rate in which all corporations in America pay, whether they are C Corps or S Corps. The top statutory rate is 35% for all of us.
Yes, but you know, the ones that had the big guns here in Washington always seem to cushion it, and they make the biggest profits, and the other businesses struggle out there. What about Mr.
Thank you. Well,
Wolf?
just in the interest of time, and Mr. Ryan, not this Mr. Ryan, that Mr. Ryan. Thank you.
Mr. Chairman, excuse me, could I ask unanimous consent that Mr. Wall answer my question on infrastructure for the record?
Without objection.
Thank you, Mr. Chairman. You guys agreed that deficits are future taxes. Is that, you guys all agreed that deficits are future taxes? Yeah. So is high unemployment inevitably then a future tax? If we have high unemployment, we have deficits, and so therefore at some point we're going to have future taxes, right?
Well, Diane?
In that sense, yes. In terms of the economy and economic growth, yeah. If we have a smaller economy, we're going to need...
Mr. Hodge, thank you.
Yeah.
Inevitably, we're all going to be paying higher taxes because right now, no amount of revenue is catching up to all the spending that we're doing.
No, I'm just saying in general, if deficits lead to higher taxes, high unemployment inevitably leads to deficits, so deficits lead to higher taxes, so high unemployment leads to higher taxes, right?
Okay.
Is that right? Am I wrong?
Sure. No, that's a complicated argument, but I'll go with it.
It doesn't seem very complicated. If we have high unemployment, we have less revenue going into the
Right, we have fewer
Treasury.
people working, fewer people paying taxes, ergo, eventually we're going to have to make up the difference.
Okay.
Congressman, I agree. Jobs, #1 priority. I'm advocating corporate tax reform would be stimulative to the economy.
So you talked, Mr. Wall, you talked about having tax rates, you know, are a contributor to your decisions that you're making, right? Aren't also consumer demand and consumer spending also a big part of that?
Absolutely, Congressman. As I mentioned, it's a myriad of factors: logistics, quality of labor, where's the market demand, taxes.
Okay.
So
high unemployment, wages being stagnant, low consumer spending equals you are less inclined to then make investments.
Yes,
No one's going to buy your product. I mean, it just makes sense.
I mean, all of my colleagues answer the macro part of it. For our business, agricultural equipment is doing well, so we have the demand, and we're expanding capacity and jobs.
Regardless of the tax rate.
No, we actually, as I tried to illustrate in my written testimony, and the United States is not a competitive regime. When we look to expand capacity around the globe, taxes, as I mentioned, is one of the factors.
Mm-hmm. But demand, someone's buying.
Oh yeah,
these.
of course, you can't make some. Yeah,
Okay.
you got to have demand. Absolutely.
Let me just ask Mr. Wall and Mr. Hodge, are we in a liquidity trap now in our country?
Liquidity trap?
We have business.
To some extent, certainly. But I think it comes back to the demand side, in which, you know, if no one's buying, if there's no market, if there's no prospects of long-term consumer demand, people are just going to sit and wait for the economy. Even if you freed up borrowing, if they don't feel like they can expand to meet whatever demand, then they won't.
If people went back to work, you know, for example, we have a 20% unemployment in construction trades right now. If we got that down to 5, 6, even the national average, 9 or 10, would that help us get out of this liquidity trap?
I don't know if any one sector can spur that.
Of course, it wouldn't be just one sector, but if we got that number down significantly, and it's a large portion, and we hired those people, wouldn't that help us get out of this mess that we're in right now?
Well, I'd like to see all sectors move.
Well, I would too, obviously. We're both.
Yeah, I mean, I
picking
don't know how
favorites.
one would spur one industry over another.
Well, we can have a more direct effect from our end on putting people back to work. If we have a $2 trillion infrastructure deficit now in the country. This work has to get done. We have a 20% on
I don't think make-work projects or infrastructure projects.
It's not make work. We got to do it at some point.
The Japanese tried to build infrastructure in order to stimulate their economy, and it just simply didn't work. And I think that gold plating the nation's highways is just not going to necessarily.
Well, we have in my district alone. We have
someone has to pay for that eventually, right?
Yeah. So why not pay for it now? Well, we have high unemployment because high unemployment leads to deficits, and deficits lead to higher taxes. It seems to me it would be better for us. We would end up paying lower taxes if we made these investments now, because we're going to have to pay higher taxes anyway because there's unemployment, and unemployment leads to deficits, and deficits lead to higher taxes. So a key to me to keep our taxes low would be to get unemployment down.
But I would hate to see our kids drive on nice highways but not have jobs.
I have 80 bridges in my district that are deficient, dangerous, all across the country. This is not a waste of money. This needs to get done anyway. So we're not gold plating any highways. Come to Ohio. Nothing's gold plated. Nothing will be. We're just trying to patch the potholes up here.
Thank you, Mr. Ryan.
Thanks.
This was a fantastic hearing. I think a lot of members enjoyed the participation, and I want to thank our three witnesses for your indulgence from going from 10 till past noon, and we appreciate it. And this hearing is adjourned.